Good evening to all. I would like to welcome you all to an insightful webinar session on introduction and application of technical analysis in financial markets, interpreting linkage between debt and equity market,
Sir,
organized by the Committee on Markets of
that's it.
on Financial Markets and Investor Protection of Institute of Chartered Accountants of India. The Committee on Financial Markets and Investor Protection works in the area of promoting investor protection by nurturing capacity and competency development of members and stakeholders in the financial market and have been actively working in the area of financial literacy for the development of economy through its various learning initiative of workshops and training programs. The Committee on Financial Markets and Investment Protection of ICI is also tirelessly working day and night on the mandate of Government of India for development of domain of financial markets by regularly updating and educating the potential as well as existing investors through its knowledge enriching investor awareness programs. We have with us the chairman of the committee, C.A. Charanjot Singh Nanda sir. Nanda sir is a Central Council member of the 25th Council of the Institute of Chartered Accountants of India. He is also the chairman of Digital Accounting and Assurance Board of ICI, Committee on Financial Markets and Investment Protection Fund ICI, Committee on Information Technology of South Asian Federation of Accountants SAFA, and Vice Chairman of Board of Internal Audit and Management Accounting ICI. He has also held positions such as Member of Quality Review Board set up by Government of India, Member of SEBI Advisory Committee on Primary Market, and Committee on Mutual Funds. He conveyor of experts group constituted by Ministry of Corporate Affairs, Government of India on investor protection. Today, we have CA Prakash Padalia sir and CA Rajiv Singh sir as our eminent speaker for the session. CA Prakash sir is a practicing chartered accountant pursuing third level of chartered market technician and trainer and mentor at Market Greeks. And CA Rajiv sir. CA Rajiv sir is a fellow member of ICI. He has served on the board of Union Bank of India from 2018 to 2021 and was the chairman of audit committee of the board and has extensively contributed in the area of internal control, fraud and risk management, valuation, treasury management and customer services practice of the bank. Also, Rajiv sir is a recognized expert on business valuation, banking, corporate finance and strategy, merger and acquisitions and restructuring, forest risk management and internal controls. Over past 25 years, he has served over 400 valuation clients across various countries and is frequently retained in complex valuation disputes. Now I would like to invite Nanda sir to please provide his insightful keynote address. Thank you. Over to Nanda sir.
A very good evening, ladies and gentlemen. We are back with yet another exciting program on financial markets. I'm extremely sorry. I am in Mumbai. We had 2-day program, very big program on capital market. And more importantly, I'm traveling. So I would not like to speak more, but I would like to reiterate one thing, that your committee is there to ensure that you get best of the technical knowledge and best of the speakers. The stock market is this time in a very doldrum state. Markets went up and then they went down. Friday, the market was up. The SGS Nifty is close to 100 points down. But largely, we have to ensure that how we could create and save our capital. Not speaking much, I would first of all thank both the revered speakers, Mr. Prakash Padalia and Mr. Rajiv Singh. Both of them are master of their subject. And I invited them, and I'm so happy that for the cause of the profession, for the cause of the institute, they are very kind here. I'm thankful to Shresh Yadav also. Yesterday, he was busy in his friend's wedding, but in spite of that, he is here today, well suited to come and take care of today's program. So, ladies and gentlemen, I would just conclude my session, but I would like to add one thing, that this profession now is at unprecedented heights. We are moving up at the highest level, but as an investor, we need to understand that we have to remain glued to the ground if we want to succeed. There is a couplet, आसमां पे किसी के ठिकाने नहीं होते, जो जमी के नहीं होते वो कहीं के नहीं होते. If you want to make money from the market, create capital, remain glued to the ground, be firmly affirmed with your great impetus of creating value and increasing your capital with stop losses and risk mitigation. Thank you. Thanks a lot. Over to Mr. Shreyash for further proceedings. Mr. Shreyash, the dice is all yours now. Thank you.
Thank you so much, sir. So I would like to invite CA Prakash Dalia, sir, to take the session, the first session.
Thank you, Mr. Shreyas, and thank you, Nanda sir, for the lovely introduction and the lovely start. Now, coming to our topic's name is the basic understanding and applicability of the technical analysis in the world of investing. Now, I'm going to focus more on the applicability of technical analysis because we as CAs, we are more focused on the fundamental part because that is what our curriculum was entirely based upon. I don't think many CAs have actually learned technical analysis a lot. We are masters in our subject. We are very good in fundamental analysis, financial ratios, balance sheet, P&L, audit report, etc., etc. But this is one side of the game which is completely unaware of. So I am here to give you a basic introduction and to get a fundamental knowledge about technical analysis. So I'll be sharing my screen. Yeah, so as Shreyan sir explained that we are market geeks. Geeks means someone who always likes to study and study. And equity market is all about studying continuously. No one can say that I am the king of the market. So equity markets is about constantly evolving, constantly studying. So we call ourselves as market geeks. And coming to our topic. Now, before going to technical analysis, I would like to give you a brief overview about fundamentals because technicals exist because there is some loophole in fundamentals. Fundamentals are not exactly to time the market. Like market can go 10% up and down. Market can go haywire because of some news. And there is zero change in fundamentals and your stock can fall by 30-40% or your stock can rise by 100%. So to time the market to earn better returns than the index, you need to time the market. And therefore, technical comes into play. So a brief overview about fundamentals. What is fundamental analysis? In the fundamentals, what do we study is, we study the industry and the business outlook. For example, cement industry. We look at the size of the industry. We look at the major player in the cement industry. For example, Ultratech Cement. It has 60% market share in the cement industry. Then we compare the margins of the peers. For example, ACC, Ambuja, Shree Cements, Ultratech Cement. We compare the margins, we compare the financial ratios, we compare the quality of the management of all the four. Then we go to the valuations part. What is basically valuations? Valuations is nothing but the price to earnings ratio, price to book value. And valuation it's itself in a very tricky concept because there are many assumptions in valuation. First thing, we may not agree on the terminal value. If you recollect in SFM subject, we used to value the business upon some terminal value. For how many years will the cash flow sustain? What is the free cash flow? At what growth the company will go on? What is the risk-free interest rate? And all these parameters can change very quickly because 2 years ago, the interest rates in US were 0%. Today, it is 5%. So naturally, the present value of the future cash flows will be lower. Then we look at the financial ratios, which we have already discussed. So all these things are very good for the long term. It might give you average returns. If you pick up a good company and you keep doing your SIP in those companies, you might get 11-12%. Because if the company is growing at a rate of 11-12%, the best you can expect is 15%. But we as chartered accountants, we are very good at fundamentals. So why not combine our technical knowledge with the fundamental knowledge and try to time the market? Now, there are certain other uncontrollable factors also. For example, a stable government. What if next year something happens and we get a coalition government? We don't know where the markets will go. We don't know how the markets will react. Second is geopolitics, something which we have seen over the last 2 years. Russia-Ukraine war, there was a war. Russia invaded Ukraine and the market fell by 10-15%. Same with Israel-Hamas. Something happens and our market collapses. Now, market is very sensitive to all these things. So these things are bound to happen. But how to catch those inflection points? How to know that the market can fall? The reason will always be unknown. But there are certain things on the chart which you can pick up that the market looks overheated. Now some event will happen and the market will fall. Third is COVID, natural calamities. During the COVID fall, what happened was suddenly some virus appeared. Within 1 2 months, it spread all over the world. There were lockdowns across the world, and the market crashed. Even during that time, were there some clues on the chart that something might happen? So all these things, all the pitfalls of fundamentals are covered by technical analysis. Now, for retail investors like us, we have very limited knowledge. I'll tell you why. Yes, we are chartered accountants. We have immense knowledge, but I'll tell you why we have limited knowledge. I met a fund manager 2 weeks back from Kotak Mutual Fund. I asked him that how many CAs have you employed? He said we have 40 CAs and some 20 25 CFAs. We have a team of 60. There are 12 sectors. We have given one sector 5 CAs, and all of them are having experience of 10 to 12 years in their particular subject. So can you imagine IT sector is covered by 5 chartered accountants who are doing that thing from 10 to 12 years. So they very well know that what is going to happen with IT sector 2 years from now, say 6 months from now, or 5 years from now. They are having plethora of knowledge and information data. Can you imagine someone in 2018 selling the automobile stocks because he knew what is going to happen in 2019-20? The BS6 engine was going to launch, and that person had the information from prior because 24/7 he is in touch with the automobile makers and probably with the government, and they are also part of the advisory committee which advises government on the entire thing on how to mobilize the automobile industry. So they are always having better access to information. Not that this is something illegal, but they are having that much information which we will never have because we cannot employ a fund manager. They are having 60 fund managers at single point of time. Another another thing is that we don't have access to management. All these people, they have institutional meetings with the management. They can directly ask one-on-one questions to the management that what are the plans 2 years hence. Whereas apart from attending conference calls where we get only 1.5 to 2 minutes to ask a question, nobody entertains us. And why would they? Because if they start entertaining everyone, they would be answerable to 1 lakh, 2 lakh people. So these people, they have expertise, they have access to management, they have information, they have qualified CA, CFAs. So whatever study you do, you will always be behind the curve. And that is where we should follow them and we should not compete with them. That is the first thing. So these are the pitfalls of fundamental investing. Not that I'm saying fundamental investing is bad. No, fundamentals is good. Somewhere down the line, if you know the stock is good, look for a technical entry into the stock. This is the gist of explaining fundamentals and the pitfalls behind fundamental investing. Now, let me give you a brief introduction about technical analysis. So basically, what is technicals? Technicals is nothing but demand and supply. Why is the market up today? Because the demand for the index was more than the supply for the index. That is the reason. Many people ask me, आज market क्यों गिर गया? I have only one answer. There are more sellers than buyers. There was more supply than demand, इसलिए market गिरा. Then someone tells me, no, that is not the issue. Something happened in Israel, that is why the market has fallen. But as a technical analyst, like the chart is the god for him, price is the god for him. He doesn't bother about any news because everything which is available on the chart, that will happen on the outside world. Now, some technical terms, demand, supply, you all know. Resistance, support, trend analysis, candlestick, chart patterns. Let me take you to my paint and I'll show you in a short description that what are these terms basically. Yeah, so my screen is available to all of you. Now, price has a tendency to move in a trend. Okay, market या तो ऊपर जाएगा या तो नीचे जाएगा या sideways जाएगा. There is nothing else that the market can do, correct? Now let us assume we are in an uptrend right now. So how will the market behave? Market will be going up like a staircase. Now what happens here is that no share goes one side up. Any share if it has to go up, it has to come down also, because at every level there is a buyer and at every level there is a seller. So the price will go up like this. It will make a high, then it will make a low, it will make a high, again come down to make a low, again a high, and again a low. Now this is, what is it called? It is called higher highs and higher lows. I'll explain you how. I'll do one thing. Let us name each of them as a high, because it is the high of the channel. The rectangle that is formed, the slant rectangle, जो resistance है, this upper area, the price is not going above it. So therefore it is a resistance. Price is resistant to go above it. And therefore, what will we call? It's a high. Price is not able to cross that high, and therefore we call it a high. And naturally, the support thing, support is one point जिसके नीचे price कभी जाता नहीं, and that is why I will call it a low. Now, if you observe, there are multiple levels of highs and lows. And if you observe one more thing, every high is higher than the previous high, and every low is higher than the previous low. If you see this high, it is higher than the previous high, and this high, it is higher than the previous high. And therefore, what do I call it? I call it higher highs. See, it's common sense. I'm calling it high because at every stage, the price is coming up and then it is going down. So wherever the price is making a high, I'm calling it a high. But every high is higher than the previous high. That is why, what do I call it? I call it a higher high. Similarly, every low is higher than the previous low. What do I call this? Higher highs and higher lows. This is the classic Dow theory. Now this is what I call a trend analysis. How do I know that कोई share ऊपर जा रहा है कि नीचे जा रहा है? By doing this only. We do this on the chart and we know that the share is in an uptrend. Now this was just a simple example, but when we go to depth of technicals, we will get more clarity. And in this lecture, my aim is not to teach you, because this itself is a 50-hour topic. My aim is to give you a gist of technicals and to give you application of technicals. So these initial 10-15 minutes, just listen to all this and then we'll go to examples. Now this is higher highs and higher lows. Similarly, there must be lower highs and lower lows also. What is it? It's a downtrend. So two things must be very clear. Price goes up in higher highs and higher lows. Price comes down in lower highs and lower lows. Now to explain you a few terms. What did we learn till now? Higher highs and higher lows and lower highs and lower lows. But what about a sideways trend? When the price is not doing anything. Price is in a rectangle. It is not going up, it is not going down. What will we call it? We will call it equal highs and equal lows. Price is just not doing anything. And similarly, एक ऐसा point जहां से again and again buying आ रही है. What do we call it? We call it a support. Price is getting support over there. There are many buyers who are waiting to buy and they are supporting the price. And second thing, एक ऐसा point जहां से again and again selling आ रही है, price is resisting to go about it. What do we call it? We call it a resistance. So till now, how many terms are pretty clear to us? Support is clear, resistance is clear, higher high, higher low, equal high, equal low. This is the gist of technicals. Now I'll go to my PPT and show you certain examples and certain rules of technical analysis. Now this is what we have just learned, correct? Support is a level from which repeated buying is seen. Resistance is a level from which repeated selling is seen. You remember this? This was the support. This was the resistance. यहाँ से again and again buying आ रही थी. यहाँ से again and again selling आ रही थी. और जो हम लोग ने line connect किया ना, we drew two lines, correct? One line was connecting the support. one line was connecting the resistance. That is called a trend line. Why do I call it a trend line? Because we are able to identify a certain trend, and that is why we call it a trend line. Trend can be any, it can be upward, it can be downward, or it can be sideways. But to gauge a trend, you will always require a trend line. Now these are the trend lines. You see these points A, B, C. What is it? It is nothing but a support, and we have connected the trend line. The first one is a valid trend line. Second one is not a valid trend line because that itself is a very strange line, right? It does not connect any points. Whereas the first one, which is a valid trend line, it is very, very well able to connect through all these points. Now, just now we have seen this price moves in a trend, higher highs, higher lows, and lower highs and lower lows. Now, coming to the candle basics. When a candle is green, what do we interpret in a layman's term? That today the price has gone up. Matlab the candle is green. And if the candle is red, it means today the price has gone down. Now it is color se hi samajh mein aa jayega that whether the price has gone up or the price has gone down. Now coming to Dow theory. What is exactly Dow theory? Dow theory was invented by Charles Dow, and he had certain rules in the market. Those rules are, one was market discounts everything. What I just said. I said that there was Corona, while some people had predicted a crash 6 months earlier by using some Elliott wave theory. And they had said that the market will fall till 9,000. And at that time, market was 11,500. So imagine someone calling a 25% fall without any valid reason. That person did not know that Corona is going to come. In fact, no one knew. But when Corona came, index went down till 7,500. Now, this was only due to technical analysis and Elliott waves. What that person says is that kuch to hoga. Matlab we'll see 6-8 months down the line, we should reach 9,000, something will happen and the index will collapse. That was his conviction of his price study. He did not know what is going to happen. He said something will happen and we are going down. Second is history tends to repeat itself. Let me share a trivia with you. 1992 market crash, 99-2000 market crash, 2008 market crash, 2016 a 25% correction. What is this? These are 7-8 years gap. 92 Harshal Mehta scam happened, the market crashed. 99-2000 Ketan Parekh was caught, 7 years gap, market crashed. 2008 was the great financial crisis. Again, then after 8 years, 2016, trouble in China, market corrected by 25 to 30%. So history tends to repeat itself. Now this is a time correlation. Similarly, there's a price correlation also. And every time certain things happen, it has happened in the past, and the same thing will happen in the future. Because nothing under the sun is new. Everything has happened and it will happen over and over again because technicals believe that history tends to repeat itself. Third thing is that with what we have just studied, price goes in a trend. So these are the general rules of the market. So till now, what have we studied? Ideally, I don't think we have studied anything. We have just looked at the basics of technicals. Now we are going to the application of technicals. Now this part is very interesting because a lot of myths will be debunked. Till now, what we have studied is only the basics, what is technicals and all of those things. Now we are going to a subject where you will realize that if, like you must have seen, result बहुत अच्छा आया company का, but next day the price is down by 5%. Why such? Result, it is not good, but next day the price is up by 3%. Why such a thing? Now this is because that market discounts everything. Market knew that result खराब ही आने वाला है. And if that bad result is also good for the market, better than the expectations, then tomorrow the share will open the gap up because the results were poor, but not poorer than the expectations. So retail public, what do they think? आज कोई share ऊपर क्यों गया? Result अच्छा आया होगा. No, it's not such. It depends on the underlying position of the share and what the market was expecting out of that particular share. I have numerous examples to share. First example is the Nifty Auto Index. If you remember in 2018-19, there was a slowdown in the Indian auto industry. Let us have a look at some numbers. 2015, 6.36% growth in sale of automobile. Okay, good enough. 2016, a growth 7.31%. 2017, 9.7%, very good. 2018, 8.54%. Okay. What happened in 2019? a degrowth of minus 11.43%, and 2020 minus 19%. Don't you think that 2019 का जो figure है, that must have come in the second half of 2019 something, because first 2 quarters जाने के बाद पता चला होगा that we are in a real slowdown. And 2018-19 economy was also in some kind of a trouble. And auto index is a leading indicator which tells us that the economy is not doing good, because auto is a thing which we buy at the last. It, like, to buy a car of 12 to 15 lakh rupees, I will first see that child's education fee is reserved or not, daughter's marriage, daughter's or child's education or marriage and everything is settled or not, and then I will buy a car. So during 2019, what happened was that there was a slowdown in India and there was a slowdown in auto sector as well. But would you believe from what level the index started falling? The index started falling from September 2018, and the slowdown began in 1920. Now, why such thing? As I told you, these big family offices or HNIs or mutual funds or portfolio managed services guys, FIIs, they have huge teams. They know the financial projection of the economy. होने के पहले they know it 1 year in advance that this is going to happen. And they have such huge data. They have data of 50, 60 years. And in US, they have data of 150 years. And whatever that has happened in US always happens in India, because in US, they have data of 150 years. In India, they hardly have data of around 50, 60 years, because we ourselves got independent in 1947. So they have all the kind of AI tools to predict what is going to happen. Therefore, this is a head and shoulders pattern. It broke down in September 2018 when the index was 10,500. Now, when the news came out, the index was at 9,000. So can you imagine, the index has already fallen by so many points. It has already fallen by 10-12% before the news came out. Now, if we are into reading Forbes magazine, or if we are into reading Auto magazine something, and these numbers pop up that minus 11.43% degrowth, what we will do? We will sell Tata Motors and Maruti. Because why? Because the sales have dumped. But 12 to 15% damage had already been done by them. The index, which was at 10,500, is at 9,000 already. So this degrowth of 11.43% is already digested by the market. No doubt. It fell after that also. But half of the damage was already done. Next thing is COVID fall. We all have seen that fall. What happened after the COVID fall? Market crashed, COVID cases were rising, and also the index was rising. So many people who were sitting at home, they were thinking that why is the market going up? And they kept shorting the index because they had nothing to do at home. Everyone was free, and it was the first time in their life that they're sitting idle for 3 months. So they got engaged into market. They kept shorting the index, many people, thinking that COVID cases are rising, there will be further lockdowns. We'll go into economic slowdown, companies won't do well. But the index had already fallen from 12,400 to 7,500. So every bit of it was already discounted in the price. And whenever there's a financial crisis, what is the interest rate during that time? It is brought to zero. So imagine the gush of liquidity. If the interest rate in US is zero, they can very well borrow money from US and invest in emerging markets like India, where the index was at 7,500. And at least they will hold till 12,500, the pre-COVID high. But what happened was that the liquidity was sustained for a longer period of time. 0% interest rate was there for almost 2 years. And today it is 5%. So COVID fall, and then the recovery. Why was it a V-shaped recovery? Because there was plenty of money being printed in US and the interest rates were zero. There was enormous liquidity. Therefore, the index kept going up. So something which surprises us, that for 6 months, these companies didn't do well. At least for 3 months in my memory. The first quarter was a washout, but it was already discounted by the market. Market already knew. So the first quarter is going to be bad. But the companies which survive now will survive for a longer period of time. Next, the great demonetization. Now, we are not here to discuss whether it was good or bad. We are here to discuss what impact it had on the market. Okay. So I'll be reading the first 3 points. GDP down from 8.8% to 5%. Okay. It's a negative thing. Second, India's fiscal deficit is up by 2 lakh crores. Again, a negative thing. IIP down from 5.6 to minus 1.1. Again, a negative thing. Okay, so all these are facts. Like all these things had happened, and this article is of September 2019. So they are just comparing that from 2014 to 2019, and demonetization was in somewhere about November 2016. So this is the article which says that so much damage has been done to the economy. As I said, okay, these are facts, we have to accept it. But what happened to the market? In the week of demonetization, Sensex was 26,800. 3 years later, I'm considering the same time period, 2016 to 2019. Even this was 2016 to 19. In 3 years period, Sensex was at 42,000. A growth of 57% in 3 years when they said the economy will collapse. Now, this is markets. You know why? Because during 2015-16, market had already fallen by 25%. Why had it fallen? I don't know. But somewhere was it in the price. The worst was already in the price. And this red line is the day of demonetization. And all these candles where you can see there's a uptrend, you can see higher highs and higher lows. High, low, high, low, high, low. And finally the high of 12,430 on Nifty. So this was the impact of demonetization on the index. I know someone very famous, is a very famous trader now. He told me that it was his initial years in the market, and when demonetization happened, he was so scared that he sold his entire portfolio. And for 1 year, he was waiting that the market will fall. But in that particular year, the market went up by say 25%. So he said, as a trader, I'm not going to look at any news. I'm not going to look at any economist article. I'm just going to concentrate on my charts. Now, one more example, like I just said, if the result is bad, next day the price goes up by 7%. As a retail investor, many people are not able to understand that why does it happen. Look at this example of Lawless Labs. These are the quarterly results, 238 crores, 267, 293, 222, 198. Chalo, theek hai. The prices, the profits are in the same range. But what happened in December 2021? Suddenly, a profit of 109 crores only. And this 109 crores was the worst quarter in the last 6-7 quarters. So can you imagine, the profit used to be somewhere around 250 crores and suddenly it reports a profit of 109 crores. There's a degrowth of more than 50%. And this company was called the next Divi's Lab because they're in the same category. And can you imagine what happened to the price in that particular quarter? The price was 440 on the day of the result. In the next 3 months, the price went to 626. How do you explain this fundamentally? It's a rise of 50%. From 440 to 626, it's a rise of about 40-50%, when the previous quarterly result was only 109 crores. There was a 50% dip in profit, but at the same time, till the next quarter results, the price was up by 40%. And you look at the next quarterly results, 109, 221, 232, back on track. So, and let me tell you, in October 2021, the price was 700, and till January 2022, in around say 3-4 months, the price was at 440. So there was a dip of 30-40% in 3 months, and then there was a rise of 30% in 3 months. So somewhere down the line, all these analysts who knew that what is the shape of the industry right now, they knew that December 2021 result is going to be bad. And therefore, the price bottomed out on the day of the result, because the price had fallen prior to the result only. Like I said, October 2021 price was 700. And when these results came out, price was 440. And then price again went from 440 to 626 in 3 months. So think about the people who are looking at quarterly results and then making the buying and selling decision. They would have made a mess, correct? Another example. Now, this is a very shocking example. I'll be very happy if somebody is able to answer this fundamentally. This is L&T Foods. They make this rice, Dawat rice. In 3 years time, from 144 crores to 199 crores. Now, look at this, 144, 137, 199. This is a huge leap. From 137 to 199 is a very good leap because of the taxation thing. But during the same period, the price fell from 110 to 13 rupees. How do such a deterioration in price? Even if there is a market crash, the price should not go beyond 50, right? 110 to 13 is obnoxious. Well, there is no other way to describe it, and I don't have any fundamental reasoning for it also. Because rice is not like sugar. The prices don't fluctuate too much. So if fundamentally, if no one is able to explain this, I think technically we can explain this. There must be some way. At least we could have sold it over here where the previous high was broken. One could have saved a lot of money. So this was about that why fundamental investing and normal thinking fails sometimes. All these examples of Laurus Labs or L&T Foods and all these examples were like COVID. So all these are challenging the normal way of thinking. Like nobody could have imagined that the market will rally so much from 7,500 to 20,000 in 3 years after the COVID crash. People were saying that 12,500 up to आएगा ही नहीं 5 साल तक. So these were the things which people said, and probably they had their own reasoning for that, because they were like, no country has ever seen such a long period of economic burden. We'll go into recession. All said and done, agreed. But finally, what happened? So there is no way to predict the market using the normal things. Some people are of the opinion that अगले साल election है तब तक तो market गिरेगा ही. These are narratives. Like I am not saying election ka result, what will be the result, what is good, what is bad, but the narrative itself that there is an election next year, therefore market will not fall. It's a very wrong one, because till now you must have understood that whatever narrative that we talked about till now, they have fallen flat on the face. So what do? We follow technicals also for long-term investing. Now, as I said, technicals is also for trading, but it is more, it's a better way for a long-term investment also. And ideally, technical analysis gives a earlier sign than fundamentals. I'll share a few examples. This is Elcon Engineering, capital goods company, and all the capital goods company have been doing very well in the last 3 years because there's a new credit cycle which has taken place post-COVID. If you look at the results, let us first look at the charts. It broke out in May 2021 when the price was rupees 112, and the results were quite ordinary till 2021. Like if you see, only look at the net profit 22, 25, 32, 27, 35, 32. There is no consistency. It's just in the range of 25 to 35. There is no outperformance. And this was till when? This was till December 2021. When did the index break out? What do I mean by breakout? The price in 2009 and the price in 2021 is the same. If you see, in the 12-13 years, nothing has happened to the price. Because between 2009 and 2021, all the capital goods industry were dead. Like there was no capex happening in the country. There was a lot of capex happening in the country between 2003 and 2007. But the fresh cycle of capex has started in 2021. Therefore, the sectors which ran between 2003 and 2007, they are doing very well now. Be it realty, be it power, utilities, and capital goods, or even the PSU companies. So what is happening over here is that 2009 se lekar 2021, the price was in a range. And finally, when it broke out, when price breaks a 12-year range, it means that something substantial is going to happen. So price broke the range at 112 rupees in May 2021. Results till December 2021 were quite ordinary. But in March 2022, profit saw a very good jump from a profit of 32 crores to 46 crores. Now it's a very good jump. For a small cap company like Elcon, 32 to 46 is very impressive. But at the time of March 2022, the price had already reached rupees 400. Digest that. 112 in May 2021. Results were ordinary till December 2021. When the result were better than expectation of the market, the price had already reached 400. At 400, you will not get the comfort to invest because you have seen that price at 100 rupees. After anything that gets 4x, you don't feel like investing. That's the human nature. And at that time, you won't even look at the valuation, because when you see that एक साल में 100 से 400 हो गया, you will only be looking for correction. You will say that let it come to 250, 300, then I'll buy. but the correction never came. Today, that company is trading at somewhere around must be 800. Another example is Usha Martin. Usha Martin, again, the same story from 2011 to 2021. Nothing happened. For 10 years, the company was doing nothing. Business performance wise, I don't know, but in those 10 years, the price did nothing. Price broke out on April 2021 at rupees 45. Okay, April 2021. Now let us look at the results. 38, 37, 68. Okay. Then there is 58, 58 and 67, 109. So by the time the price saw a substantial jump, one was from 37 to 68 when the price broke out, and the other was from 67 to 109. But by the time the March 22 results came, which was very convincing, because if the profit triples in some quarters, it means the company is on the right track. By the time that happened, the share was already trading at 120 rupees. So if technicals give you early entry, if you can get an entry at 45 and you take a stop loss of 20%, but when it's a multi-year breakout, the target is not 50-60%. The target is at least double. So that was a 45 rupees stock. Today, the stock must be around 350, 300 range something. So all these multi-bagger type returns are possible in technical investing also. You saw it in Elcon, 112 say 800, then Usha, 45 to 300 something. And this is based on a simple concept. Just look at multi-year breakout. Look for stocks which are breaking highs of 10, 12 years. And you will find many stocks from 2008 to 2020 which have done nothing. Power companies. I'll be showing you more examples. State Bank of India, bluest of the blue chip stock. What did State Bank of India do between 2010 to 2021? Nothing. It was 350 rupees in 2011. It was 350 rupees pre-COVID as well. But something changed in Feb 2021. The price broke out of a multi-year resistance at 350 in February 2021, and SBI delivered a fantastic results in September 2021. Look at the jump in profit, 7,700 crores to 9,300 crores. This is 15% Q on Q. A bank delivering a profit of 15% in Q on Q on the back of the COVID NPAs. Till September 21, I think all the provisions must have been done, and SBI would have returned back some amount from in September 2021 quarter. So from 7,700 to 9,300, and SBI had provided wonderful clarity during that time that the monkey is off our back. COVID is history, and now we are ready to go. And by the time the result was out, the price was 500. It broke out at 350. When all the NPA worries and COVID worries were gone, the price was 500. Elephants can dance. From 350 to 500, you can never imagine a stock like SBI doing this in 6 months. Ambuja Cements, if you remember in September 2021, Adani Group had bought Ambuja and ACC both. At what prices? Ambuja was bought at 400 and ACC was bought at 2,400. But these both are also multi-year resistances. From 2015 to 2021, Ambuja had not gone anywhere. For 6 years, it was in the same range. And then suddenly something happened and the price broke out. And after a few months, the news came that Adani is acquiring Ambuja. In September 2021, it broke out in Feb 2021. Why did this happen? I have no clue. Probably because it was there in the news for past 6 months. There was due diligence and everything. Wholesale Investment wanted to sell Ambuja ACC, and if a corporate group like Adani comes into picture, and naturally the shares which they acquire get a premium valuation. Similarly with ACC, from 2017 to 2021, the share did not do anything. It did not post a new high. But in March 2021, it broke the high of 4 years, 1750. And in 6 months, the price was 2,400. So even in medium term investing, if you're looking for 30-40% profits in 6-8 months, it is possible. You just have to be at the right place. Aarti Drugs, this is the rock star of COVID, because what had happened was that China was fully under lockdown, and this company, Aarti Drugs, it's a API company. So what happened was that China plus one, it's a narrative now. It wasn't back then, but this company got a lot of advantage because of that. It got plenty of orders, and you can see in the result. March 2020, the net profit was 136. March 2021, the net profit was 258, almost double. But when did it broke out? It broke out in May 2020 when the price was 200, and by the time the result of 2021 was out, the price was 700. In 1 year, 3.5x times returns, and the result had doubled. The profit had doubled. Then it again went into correction because again China was back, and China got most of the work. Even today, Aarti Drugs is into correction because this was a one-time thing. If you look at the past few results, they are not great. And this jump in profit, like 3.5x in 1 year, this is not the kind of thing which happens too often. Actually, it wasn't even 700, it was 1,000. It went up 5 times in 6 months. All these big green candles you see are all 100% candles. So sometimes these things do happen, but when you catch this 2015 to 2020, if you catch this and you buy it with this as a stop loss, you enjoy all the gains. Even if you book it 100% in 2 months, that is fine. That is what we dream of. Now, does this work in blue chip stocks? Yes. In year 2000, HUL was a blue chip stock. In 2020, it was a blue chip stock. But in 2011, from 2000 to 2011, HUL did not do anything. If you look at this blue line, the price has never gone above the blue line. This was 2000, this is 2011. When the price was 320, it finally broke out. And what happened in the next 10 years? Price went to 2,500, 8x. And this is plus the dividends, the capital gains plus the dividends. So you can imagine the kind of returns. And HUL is a share there. आज अगर ले लिया तो रात को नींद आएगी. It doesn't, your money is not going to bonkers. You buy it at 320, you hold it for 10 years and you get 6-7x percentage, 6-7 times returns. And we all, the members of the institute, I assume we all are very busy. Some are into practice, some are into industry. So we don't have the trading thing in us. We all are long-term investors. We have surplus inflow every month. So if you're doing a SIP, you should do mutual funds, but at the same time, you can also do mutual fund in such stocks because you know that this this stock is coming out of a consolidation of 10 years. HUL is a good company, and for the next 10 years, it is going to rally because when there is a spring, the more you press the spring and then you leave it, the more it will rebound. Similarly, in technicals also, if something has not performed for 10 years despite it being a good company, it will do very well in the next 10 years. Another example is Reliance Industries. From 2009 to 2017, Reliance Industries did not give any returns. The fundamental reasons were that it only had the petrochemical business. It did not have anything else. From 2017, Jio came in, Reliance Retail came in, and the price got the impetus to perform. And what happened after that is history. Reliance was 480, and after that, Reliance today price is 220. So in 6 years, Reliance has gone up by 4x, 5x times. So if the largest capitalized stock in India, if it has gone up 4 times in 6 years, you have the security as well because you are investing something which is very big. It's an elephant, and it is also giving you a multi-bagger returns. When did it break out? It broke out in Feb 2017. If you look at the results after that, March 2017, the profit was 30,000 crores, then 36, 40, 40, 54, 68, 74. So in these many years, from 2017 to 2023, the profit went up by 2.5x times and the price went up by 4x times. This is how you identify multipliers. Only on the basis of charts. I'm not even looking at the P&L and balance sheet. For our satisfaction, since we have that skill, we can always do that, but it is not really required if you have a stop loss in place. So till now, I think it is pretty clear that Can technicals be used for long-term investing? Yes, we have seen enough examples. And if you make a portfolio of 10 stocks, let us say we allocate rupees X each in 10 stocks, and we keep a 20% stop loss in each of them. Probably five will hit the stop loss, five stocks gone. Another five, at least two will double, and another one will go up by 2x. So overall returns, I can say that it will be 20% because you're investing into something which is really going to be in fashion. In some of the stocks, like in RT drugs, you have seen that from 200 to 1000, Reliance 4x in 6 years, HUL 8x in 10 years. So when you get all these kind of multi-year breakouts and you make a portfolio out of it, even your portfolio can outperform. Now, having a look at the current market scenario, which sectors are likely to do well in the coming years. As I said, between 2003 and 2007, some sectors like real estate, power sector, PSU companies, infra companies, these all sectors did really well because India was a growing economy. India used to grow at 6-7%, which is not imaginable right now. And that is the real growth. Without any inflation, India was growing at 5-6%. So during that time, there were many projects, like there were utility projects, there was realty was booming, infrastructure was booming. So during that time, capital goods, all these industries were doing well. And then in the next 10 years, from 2009 to 2020, all these sectors were sleeping. So the entire sector was sleeping for 11 years, whatever sector I just mentioned. And in these 11 years, what performed? IT performed, banks performed, and FMCG performed. Now, what is going to happen post-COVID? It is already happening. What is going to happen post-COVID? Let us revisit all the sectors again. BSE Capital Goods Index, as I said, 2008 ka top, it did not get removed till 2020. For 12 years, nothing happened. And as soon as it broke out, the returns are in front of you. This is 20,000. It broke out at 20,000 and it is 50,000 right now. So already a 2.5x returns in how many years? 3 years with 2.5x. And what companies fall into capital goods? You have your L&T, Alcon Engineering, we already seen the example. And you can always add which companies fall into capital goods. I'm not a SEBI registered advisor, so I'm not advising, but this is only for educational purpose that how to interpret the charts, the sectors, and which stocks to invest into. Then the other is Nifty PSE. Nifty PSE means public sector enterprises. 2008 ka top did not get removed up till 2023. 15 years of slumber and nothing happened in this. And what happens is that it breaks out at 4,500 and in very few months it reaches 6,000. If you were active in the market in the last 6 months, you must have seen the railway stocks were running. All the PSU banks and the PSE companies were running. There's a reason behind this. There can be any narrative. I can write any narrative for you. You just tell me, acha likhna hai ki bura likhna hai, I write it for you. And I'll make it very convincing also. But once you follow the charts they rarely lie. And this is a chart which is not lying. So if someone had bought this multi-year breakout at 4,500, be it a funds of funds, you tell your fund manager, I want a public sector enterprise funds of funds. You buy that, you keep it, and you're already 30% up in 6 months. Next is PSU Bank Index. Do you remember late our fellow member, Shri Rakesh Junelwala? His last interview, he was asked that which sector are you, name 3 sectors you are positive on. He said PSU banks, and PSU banks. Now you get the reason behind it. 2011, PSU bank high was the same as 2022. So 14-15 years and PSU bank had not moved. And the corporate governance in PSU banks right now is much better than what it was 15 years ago. You call it corporate governance, or you call it better technology at play, or you call it the India stack, the role of Aadhaar in giving loans. The underwriting procedure must have improved. So therefore, probably fundamentally also he was of the opinion that these are available at very cheap valuations, less than 1 time price to book value. And also the chart is suggesting something. And even he was of the opinion, Mr. Madhusudan Kelaji was of the same opinion. And slowly it became a crowded space, but the chart till now says that abhi tak hila bhi nahi hai. So you can always buy PSU Pangbis, or you can go into SBI. It itself was a multi-year breakout we have just seen. And in the coming years, in the coming 3-4 years, you can earn handsome returns. Next is reality index. For those who are in Mumbai, since I am from Mumbai, I am looking at the ground reality. There are so many redevelopments, especially the place where I am staying. There are I think the half of the location, half of the town where I stay, it is in the redevelopment. And this happened post 2020. Everyone was of the opinion that 2020, there is COVID, nothing will happen, infrastructure gone, forget real estate. But I was of the opinion that it should do well because the price was showing me something. There was a reality index which was breaking out, there was an infra index which was breaking out, cement stocks were doing well, and it was just not due to liquidity. There were other factors also. Interest rates in US were zero. Here, the housing loans were available at 6.5%. So this was the time to go into real estate. And after every stock market bull run, all the investment that the investors have made that goes into real estate. So after every stock market bull run, the real estate market starts booming. This is the cycle. And this is exactly what turned out. In 2021, the index almost broke out. Finally, in mid 2021, it broke out. And the price during that time was, let's say, around 300. And today it is standing at what price? Today it is standing at around 600. So it is already double in 2 years. And you can look at some market leaders in this space, like there is DLF, there is Oberoi Realty, there is Godrej Properties. So I believe the real estate sector is bound to do well. Probably not now because the interest rates have increased, but the projects which have already taken place and they're going on, I guess the future is bright for this industry, especially after a stock market bull run. So in a nutshell, with reference to price, technical analysis is a leading indicator because we have seen that many a times if the index is breaking out in March 2021 and September 2021 result is outstanding, in the 6 months time the price is already doubled. We have seen numerous examples to prove that. Therefore, fundamental analysis is a lagging indicator. एक बार हो जाएगा, price बढ़ जाएगा, फिर result में दिखेगा. उसका कुछ फायदा नहीं है. We want to earn money. Whereas in technicals, if you buy it at 100 without seeing the result, keep 80 as your stop loss. The price doubles, results came, you sell it out. You have made 100% in 6 months. That is more than sufficient. Look for some other stock. So this is what technicals is all about. It is not about speculation. I don't encourage speculation. I myself don't do derivatives because I don't have the time to do that as well. I'm a hardcore technical investor, and in a bull run, like anything and everything works in a bull run. But if you try to find the method in madness, prices are random. No one knows where the market will go tomorrow. But if you find the method in madness, you can crack the game. Therefore, use technical analysis to buy stocks that are fundamentally strong. If you are scared, go only into Nifty 500. Nifty 500 means there are 2,200 listed stocks. Nifty 500 is the top 500 biggest companies of the listed space. So this is the in-depth this is the in-depth technical analysis. For example, like there are many things. There is candlestick patterns, and there is candlesticks, there is patterns, there is indicators. This itself is a 50-hour topic. There is many candlesticks, indicators, and how to use all that together. So it is not possible to teach this in a short time frame. So today's session was aimed at showing that what is the application of technicals. Now we have learned when to buy, but when do we sell? There has to be some reasoning for selling also. You cannot say that 100 में लिया था 200 हो गया बेच देता हूँ, नहीं. We have seen that 100 का stock 400 भी गया हुआ है. So you cannot say that 200 में बेचना है. How do we sell? One of the methods of selling can be using an indicator which has often done very well and it has often predicted market downfalls. It is one of my favorite which I use. It is called the relative strength index. Now, what is the relative strength index? Let us break it up. Relative मतलब क्या? Relative मतलब कि Sachin played well, but he was relatively better in the last game. So I am comparing Sachin's performance with Sachin's performance. I am not comparing Sachin with Rahul Dravid. I am saying Sachin played well in context of the last game. Relative basis पे Sachin played well today. Okay, so that is relative. Strength we all know. Price is showing strength मतलब क्या? The price is going up. And index मतलब कि some complex mathematical calculation has been done and they have made an index out of it. So relative compares the price against its own past performance. If from January to March, if the price has gone up by 100%, and from April to June, if the price has gone just by 20%, it means that the price is losing momentum. So this is relative. Price 20% बढ़ा है ये quarter में, but in the earlier quarter the price had gone up by 100%. So this is relative. It means that the price is slowing down. The car is going ahead. If the car was traveling at 100 and it is traveling at 20 now, the car is still going ahead, but at a slower pace. This is basically a selling signal as per RSI. I'll be showing you what is exactly RSI, but just listen to this. RSI is a bullish indicator. When RSI is up, price is bullish. When RSI is down, price is not bullish. It means that whenever RSI is going up, it means in normal conditions, price is bullish. And RSI is a percentage number. It travels between 0 to 100. So let us say if RSI is 60, anything about 50 is bullish because natural probability 50% price ऊपर जाएगा, 50% या तो price नीचे आएगा. If RSI is 60, what do I say? That the price is bullish because it is above 50. If the RSI is down, if RSI is 30, I'll say that price is not bullish. It has seen a lot of bearishness. Therefore, when price goes up, RSI goes up. When price goes down, RSI goes down. How to use RSI? Avoid high RSI stocks. You know, RSI का जो calculation है, that is based on 14 days or 14 weeks or 14 months, depending on the time frame. Why 14? Because 14 is the gap between half moon day to a full moon day and full moon day to half moon day. Why? Because traditionally people believe that trading is a mindset game and our mind is controlled by the moon. Our body is 70% water. Agreed? Even earth is 70% water. Why is there high tide and low tide? Because of the gravitational pull of the moon. If there is a Purnima, there is high tide during that time because the gravitational pull of the moon is higher. If there is a no moon night, there is a Amavasya, there is a low tide. Why? Because there is no gravitational pull from the moon and therefore water is not rising. Similarly, in our bodies also, when there is a Purnima, our emotions are inflated. And that cycle is of 14 days. So what astrology or science, whatever you say, our body is 70% water and our body and mind is influenced by the moon. Because if large water bodies can be influenced, we are just humans. Even we can be influenced by the moon. That is why this calculation is based on 14 days. So one technique can be avoid high RSI stocks. What do you mean by high RSI stocks? If RSI of a stock is 90, it means that in the last 14 days, 90% of the times, the price has closed in green. So if in the last 14 weeks, months or days, if in the last 12 to 13 weeks, months or days, the price has closed positive, it means that profit booking तो हुआ ही नहीं. अगर last 14 days में से अगर 13 days तक price ऊपर ही गया हुआ है, it means that somebody must sell ना. If the price has gone from 100 to 150 in last 10 days and there is no profit booking, that itself is fishy. No one is booking profit. So when RSI is, let's say, above 85 to 90, that is a good thing to sell. But the only condition is that it should be either on weekly or monthly time frame because we are investors. We are not traders. For traders, daily time frame is a good time frame. But for investors, if with a monthly chart, what do I mean by monthly chart? One candle represents 1 month. Whatever chart that we have seen over here, they are all our monthly charts because I have only covered that 2008 से लेकर 2023. So all these candles, one candle is equal to 1 month. So for investors, weekly and monthly chart, ये जो 1 month लिखा है ना, you can do that into 1 week also. So what will happen is that ये जो एक candle है, that will get subdivided into 4 candles. And the chart जो थोड़ा बड़ा दिखेगा because the number of candles which are over here, there will be 4x of what we are seeing right now. So whenever there is a high RSI stock, we should be selling that stock if we are an investor and if you are into good profit. Some examples, Adani Enterprises, RSI was 96 on monthly chart. It means that 96% of the times, this stock had been positive in the last 14 months. This is something very rare. And then came the Hindenburg report. Hindenburg report came in January 2022, and you all know what happened. Price went from 4,000 to 1,000. There was a 70% correction, and this was because the RSI was 96 on monthly time frame. It is unimaginable. Then another one is Hindustan Copper. RSI was 90 on weekly, and the price crashed after the correction started. The price crashed from 194 to 80. If you are a sound investor who has invested somewhere about over here, looking at this breakout, if you draw a trend line connecting all these dots, you get a breakout over here. If you have invested somewhere over here 50-60 rupees and the price is 194 and the weekly RSI is 90, you would better sell, because the RSI 90 on weekly, it means that whenever the correction will begin, ये stock आधा हो जाए. Price crashed from 194 to 80 rupees. Imagine holding such a stock. You bought it at 80, goes to 194, then again back at 80. No use. Then Laurus Labs. RSI was 95 on monthly time frame. What happens next? Price fell from 700 to 280. This is the same example. 700 say it came down to 440. 440 say it went to 626. 626 say it went to 280. Lower high, lower lows. If you can imagine, ऐसे 700, 440, 626, 280. And all of this started when RSI was 95 on monthly time frame. Then another example is Subex. Subex is my personal favorite investment of lockdown. The RSI was 92 on monthly time frame and the price crashed from 74 to 18 rupees. 74 to 18 rupees is something which is not digestible. For someone, even if someone has bought it at single digit, imagine if someone had bought it over here. Here the price was, this was a multi-year breakout. This is another multi-year breakout. Price was 16 rupees over here. So if someone has seen from 16 to 74 and from 74 to 18, you can imagine his state. If he has put even 1 lakh rupees, 1 lakh went to 4 lakhs and 4 lakh came to 1 lakh. He would have better studied technical analysis before investing, right? Or at least at the time of selling. Then we have Tanla platforms. RSI was again 96 on monthly and the price crashed from 2000 to 500. 70-75% correction. No, these things are very unheard of, because in the last 3 years, we have only seen one side market going up. Even if there is correction, the maximum correction that we have seen index-wide is only 18%. That too during Russia-Ukraine war. We have not seen stocks going down by 80-90%. If you look at the 2018-19 period, when the mid-cap and small-cap index, that itself was down by 60%. There are many stocks like Dawat, which came down from 110 to 13 rupees. And valuations cannot justify. 110 पे भी वो justifiable नहीं था, इतना ज़्यादा था, and 13 पे भी justifiable नहीं था क्योंकि इतना कम था. There was no equilibrium in 2018-19. From top-notch valuations to bottom valuations. Index correcting by 60%, you can imagine where your stocks would have gone. Now covering another concept, which is RSI divergence. As I said that if the car is going at the pace of 100 kilometers per hour, and then the car continues to go ahead and it sees a toll naka, so the car will put some brakes on. So while putting the brake on, uh, the speed will fall from 100 to 60, 60 to 40. कार तो आगे जा रहा है, but what is happening, the speed of the car is slowing down. So if you ask me, ये स्टॉक में इन्वेस्ट करूँ क्या, आई विल से ऊपर तो जा रहा है बट अभी फिलहाल इन्वेस्ट मत कर. दिस स्टेटमेंट डजंट मेक सेंस. somebody will say ऊपर जा रहा है तो इन्वेस्ट क्यों नहीं करूँ. This is the answer. RSI is the speed of the stock. Okay. If the RSI is going up, the price is going up. I've explained you this, but there are certain exceptional circumstances when the price is going up, but the RSI is coming down. Same car example. Distance wise, we are going ahead. Price is going ahead, but the speed is coming down. अगर 100 किलोमीटर पे चला रहे थे, now we are at 30. We are covering the distance. आगे तो जा रहे हैं, but the speed is coming down. It means that brake लगने वाला है. Similarly, RSI में भी same है. The bottom grid which you are seeing is the RSI. You are able to see the reading 50.77. As I said, percentage terms में होता है वो. And this is the price. Okay, if you see the red line is going up. Matlab, the price is going up. Whereas if you see the RSI, the price is going down. And what happened after that? The price crashed. 800 rupees say it came down to 350 rupees. And this was the starting point. Ekdam all-time high pay, there was a RSI divergence. It means that the price is telling me price is in momentum. The price is going ahead, but there is no speed. It means that brake lagne wala hai. Next example. This is what? This is Sensex. The price was going up, but the RSI was coming down. See, you see these two lines. It will be very crystal clear that the price was coming up, but let us say the RSI is like a speedometer. The speed is coming down and the price was going up. It means that brake lagne wala hai, and this was the start of the correction in October 2021 when index fell from 18,600 to 15,200 in a span of 8 months. Tanla platforms, we already discussed. Tanla ka kya hua tha? From a ATH of 2000, it fell to 500 rupees, and there was a RSI divergence on monthly chart. If there's a RSI divergence on monthly chart, it means that the share is going to crack at least by 50%. And the same happened in Tanla platforms from 2000 to 500. People compared Tanla platforms with Twilio of US, but all these were narratives and the price had the answer. Adani Enterprise, the epic collapse of Adani from 4,000 to 1,000, was it predictable? It was. There was a RSI divergence which lasted for quite some time. Even after the divergence, there wasn't much movement in the price. But it was a cautious sign because RSI was 96 on the monthly chart and there was bearish divergence on the weekly chart. So if I'm getting these two big indications, what do I assume? That इस शेयर से दूर रहना ठीक है. And I advised a friend of mine that because he was holding Adani Enterprises since 200 rupees and the price was 4,000. And he asked me what to do. I said, at least exit half of them. If you have said you have 100 shares, you sell 50 shares, get the profit home and let the another 50 flow. I don't know what he did after that, but the price crashed from 4,000 to 1,000 and I didn't bother asking him what did he do. Again, we have covered this example also, Hindustan Copper. If you remember, the RSI was 90 on monthly time frame and there was a divergence on weekly time frame. So very clear-cut signals that this stock is going to go under the hammer. The high was 194 and as we have seen, the low was registered at 80 rupees. To see a drawdown of 50% in our portfolio share is not an easy thing. Okay, so this was a basic introduction to technical analysis from my side and a basic application. We haven't really learned anything in this session because the basic purpose was showing you the application of technicals in long-term investing. And as I said, there are plenty of things. There are candlestick patterns, then there are bar chart patterns, there are indicators, then how to make a scanner out of it. how to make an algo system out of it, and then trade or invest. So many things. And you can also combine, let's say something like a India VIX. So whenever India VIX goes about, well, it is time to be cautious. Or you can also combine macro analysis with this thing, intermarket divergence, what's happening with crude oil, what's happening with US bonds, what's happening with USD INR, what is the correlation of Nifty and USD INR, what is the correlation between US oil going above $90 and Nifty correcting. So many interesting things. Unfortunately, not everything can be covered over here, because my main focus was to bridge a link between fundamentals and technicals, since we all are from the fundamental backgrounds. We all our life we have seen audit reports and notes to accounts, balance sheet, PNL. So I tried linking fundamentals to technical, and just to show you that technical has been a step ahead in identifying stocks than fundamentals. Not saying that fundamentals is bad, but in a nutshell, uh, we should think that let us apply technical analysis to fundamentally strong shares, because in fundamentally strong shares the volume is big. So in whatever shares the volume is huge, there is mass participation, and technicals works better whenever there is mass participation. This was from my side. Now let us have a small doubt session. If anyone is having any doubt, we'll figure out a way of addressing the doubts. So can we open the session for doubts, please?
Yeah, sure. I'll be addressing the questions of members, if any. Just
Yes.
give me a minute. Yeah. Prakash sir, I don't see any questions related to it.
Okay.
Yeah.
Yeah, this was about it from my side. Hopefully, I've done justice to the entire topic.
Definitely, Prakash sir, definitely. So I would also like to welcome Rajiv sir also to the session, and I would like to invite him for the second session of today's session. So over to you, Rajiv sir.
Okay, thank you. Uh, First of all, am I audible? So,
Yeah, sir, you are audible, sir.
so I'm sharing my screen. Okay,
Sure, sir, sure.
is visible the screen?
Yes, sir.
Okay, so good evening to all of you, and thank you very much, ICI, for the program which you called me today. The very important topic of linking and interpreting the linkages between debt and equity market. Uh, Most of the time we'll try to understand equity market in isolation without looking at the the important indicators which probably will be more certain and give you a kind of input based on which you'll be able to predict the market in a better sense, and also for a lot of decision making, whether for financial decision making and also for your for investment purposes and valuation purposes. Some of the examples which I'm trying to capture here in today's session of 1.5 hours, and hopefully, as and when you want any questions, you can raise it, and we'll try to address all those answers at the end. These are all based on fundamental part of the debt market understanding and equity market understanding, right? So, first important thing which I'll try to address is uh, these three important, factors. First is and I'm just first focusing from the epicenter of the world market, especially the US. And there are two D's you can see in this US. One is your debt deficit, and then the government debt. And the third critical element is the debt limit. Important for us to understand is that in the entire world, there are only two countries. One is the prominent one is the US, where there is an absolute amount for debt limit. And therefore, every time you see, because of the higher spending, if that limit is about to be crossed, or it is, every time they require to increase the absolute amount to carry on the business as usual, because we are talking about the government debt. There is a very specific, understanding about the government debt, a little bit different as compared to corporate debt, on which we understand. So once we are clear on those aspects and the global dynamics, add it with this, with the geopolitics, you'll be in a better shape to know which way the market is going to go and what is the medium term, long term, and short term features would be. So this particular efforts of mine in today's session is directed towards drawing, attention of people who are joined today, or maybe using this webinar programs for later on reference purposes, to look all those parameters and then interpret them, infer from the data given, and try to correlate and make a better decision making part. While elaborating more on behavioral part, I would also wherever possible in this time to bring some issues related to behavioral aspects, and that is called in a behavioral finance angle, because you try to explain the market based on fundamentals, and sometimes you find that those fundamentals are not working in a mechanical function. So we believe that there should be a formula, there should be a rule, a market should behave based on that, but you will not find those details, things happening, and also within the time frame which you expect, the market can misbehave, and those characters or those aspects are basically behavioral aspects, and the most critical behavioral aspects in financial world is heuristics. So heuristic is a term given by behavioral expert to say that, to explain a process whereby you rely more on shortcuts, right? You rely less on more detailed analysis, because it requires more computation, it requires more time, more application of mind. So it is a tendency of human being to decide not based on robust, detailed analysis of a subject or information, but go more for sort of shortcut, and that's what the heuristic says. So you will see those behaviors are getting reflected, but if you can purge both aspects, one is the behavioral part, another is the fundamental part, slowly you'll be able to catch the market in a much better way. So let's first focus quickly on some build-up exercise, because I'm sure some of you will be pretty much aware about what I'm discussing in first 2-3 slides. But just to build up, I'll go through by focusing on those concepts, and then we can come back on more data, more information from the market, so that we'll have understanding of live thing happening. I'm starting with US because if you understand that market, you can correlate and then of course find the impact in other sectors of the world, which may not be exactly is a mimic of that what is happening in US, but it gives you an idea. And why I'm saying so, because there will be a lot of lack of information available in other part of the world as compared to the availability of data in US, and that helps us to make a better prediction. So the first two Ds are very different concepts. One is your government debt and the government deficit, right? So we need to first understand, and these two concepts are totally interdependent. And if you can find out some linkages out of that, you'll be able to predict the long-term behavior also. So we'll see that in future. from today's debt position of around roughly $32+ trillion in US, the debt deficit which we talked about, right? In next few years is going to be around 40 trillion. So if you take, depending upon 3% or 4% of interest rate sustainability, so roughly 1.4 to 1.6 trillion kind of a interest rate payment would be, one of the component of the US, whole government, deficit part. If you want to understand how big that size is, so in India we are just $3+ trillion economy, and there they are paying interest would be around 1.5 to 1.6. This is a mammoth. Will it be reduced? Is it going to be expanded? How it is going to affect the whole market? And then, of course, what is the composition of the foreign exchange reserves in US in terms of world currencies? These are key factors in futures which will affect not only the financial market, the macroeconomic issues and other part of that. So let's first understand that when we talk about deficit, so we say in India we see what the deficit is. So we see deficit over a period we calculate. So each year I say this is my inflow and this is my outflow, and if there is a short flow in a layman sense, you'll find a deficit if your inflow is less and an outflow is more. And there is what you have to focus. If your deficit is rising, you need to raise debt, okay, to support that deficit. So deficit is a periodic calculation. So yearly basis you find the deficit. So how much there will be a deficit, and then you accumulate over a period to support that, and that's what we call it as a government debt position. Is it bad or good? Which you see later on. The problem happens that if the debt amount which is getting accumulated because of the fact that every year there is a deficit which is getting added to the existing one, and if the interest rate is low, or if it is a manageable level, say less than 2% in US, that might not affect the economy, can go ahead. But if it moves into 3% or 4% sense, it is going to affect the whole economy, and of course stock market and any other places. I mean, this is very strange phenomenon. You can see if you compare 2008-9 when global financial crisis came, because there was a lot of toxic asset which were built up over a period, and of course in pursuit of generating very high kind of income over those assets, and as a result we saw something which was called global financial crisis. So a lot of people learn lesson and say, okay, fine, now we'll park our money into government debt. I'll discuss that because that's the epicenter of evaluation, right? Especially the US. We'll discuss about the risk-free rate and the impact of that in the economy, because all assets price across the globe, right? You talk tangible, intangible, whichever you want to talk, financial, non-financial, each one gets affected if there is a change in interest rate of what we call it as a risk-free rate, a true risk-free rate. We'll discuss about the definitional part of that, right? So mapping them and understanding their flow in future is a very important part, and that also is going to tell you in future, because whatever you do in analysis or fundamental analysis, I'm mostly talking, I'm not right now. You have the session on technical analysis. These aspects will have an impact for not only in US, because it has a ramification across the globe. So it can go to any place and any part of the world gets affected because what happens there. So I picked up from there and then slowly moves towards, we'll also try to understand, at least if you can cover in 1.5 or 2 countries. So there are a lot of variables coming up, which we'll see, okay? So it is very simple, fundamental, that if the debt, so 2 Ds, I think absolutely clear to all of you, that if the deficit each year is going to go up, so your debt is going to go rise. it gets accumulated, right? And at some stage when the interest rate will be higher, it'll get killed for. So this year and the last year, you've seen in US, people moved away, learning lesson in 2008-9, parked a heavy amount of money, especially banks, pension firms, insurance companies. They parked money in something called risk-free asset, a pure theoretical risk-free asset, which is a US government security. I'll tell you that how risk-free assets are defined, and then is that exactly the risk-free in today's world? That we see the behavior of the same market where they are treating this as a risk-free asset. So the banks which failed in US, they failed not for investing in toxic asset or adopting an operational, kind of a mechanism where they are, lending to substandard, customers. Rather, they got affected because they invested heavily in risk-free, so-called risk-free asset, which is a government security of US. And as long as the interest rate was in control, that was fine. But when the interest rate started rising, we'll discuss about that implication. And these are the two important, factors we need to know. One is your deficit, another is the accumulated amount of deficit, which is your debt. So maximum, because if it is started touching 5%, around that, 4.5% and 5%, unmanageable kind of a debt. The result was that because if your yield is going to go up, then the value is going to go down. And most of them, they faced a music on something called marking to market. And it became unsustainable for them, even though investment was made in risk-free asset, okay? What we call as a risk-free asset. So if you don't map the amount of debt, the potential of sustainability of that debt, and then continuing on running feature. So the way US runs today, we'll see some components later on. There is very little scope to reduce the debt getting accumulated, right? And therefore, there will be an impact of that in future in terms of your overall deficit every year. And that will have a huge impact on your, if you can see the composition of currencies, which has also I'll show you later on with some data, that is people are getting out of this US currency every year. So in the last few days, you've seen, roughly $20 billion US currencies is out. These aspects are something very, is an inflection point of the economy. This is happening after a very settled period over maybe around 50, 60 years where there was certain kind of a prediction happening, and then you go and decide based on that, okay? So if I look at those, pictures, especially about the debt component part, and then look at the interest rate of that, the impact of high interest rate is basically, will have a huge, implications, especially for those economies where the economies are bank-driven economy. There's in a capital market, you have a capital market-driven economy where people, raise money from equity market, debt markets. The situation will be slightly different versus country like India, where a debt-driven or bank-driven economy. So the bank does well, the economy does well. In that situations, this kind of a phenomenon will have a huge impact. And in the third element is about debt ceiling. So you'll see the behavior of the market. I will show you today, and that is what the part of I said. I'll be covering a little bit of behavioral finance because in 1.5 hour time, we can't go in more detail. Same event, same kind of situation, you would expect the people to behave similar, right? And I'll show you that people have behaved absolutely in a different manner. And that's how the behavioral aspect is, or also understanding the fundamental. Why, on what region people have not followed what was there in the past. And three stories: government debt, debt deficit, and the debt limit. Of course, we don't face, because economies where debt or physical, prudence are maintained based on certain percentage of the GDP, then that is more flowing versus the one which has a fixed kind of thing, right? So we'll see that how this debt thing affects, overall, yeah, the market when I look at in one by one that segment. So just look at this data set roughly. US. I'm just giving three important dates so you can just pick up, and I'm sure few of you would have been watching regular basis the details and the data which are released in the market. And then of course there are a lot of agencies predicts also. So December 16, 2021, you can see here from 2.5 trillion to US dollar 31 point, debt limit raised, and then finally is reached to roughly close to 32 trillion or 31.4. That was on December 16, 2021. That's the one raise because they needed more, because at this stage, it is very important if I go to the next day to explain you that there is a big difference between a corporate debt and a government debt. A government can always, refinance. It's a government, so it can refinance the debt, which probably will be very difficult exercise in case of a corporate, right? And why? Because they can issue a new instrument and further repay the old one. The problem happens when there is no taker of the debt or the interest rate misbehaves because of the market situations, right? In that situation, the market behavior will be totally different. So here what we are observing that something which was noticed in 2021, that the debt limit in absolute term, which was frozen, is going to be, somewhere by May 31 to 2023, it is going to be breached. And therefore, you have only two options. And that one option is to either get your debt limit increased or default. Okay. So you say that, how it is going to affect? It will affect because if US government debts, if they default on their payment interest and principal and time, that will be a massive hit across the globe because we'll see that the risk-free rate is the most foundational part of any asset priced across the globe. And therefore, you have to understand that we are talking about any market, the fundamental part of the market is the risk-free rate understanding. In fact, let me at this stage to clarify the risk-free rate has three components. The first component is your real interest rate. Then second component is the inflation component, and the third component is the reinvestment risk. So you get compensation principally for all these three components. Reinvestment risk is the risk of investing your coupon during the life of the bond at a different rate. A true risk-free rate, a true risk-free instrument should not compensate for any kind of a default risk. So principally, if I call it a US security as a risk-free instrument, so there should not be any compensation in the yield of US security for any kind of a default because there is no expectation of default. But if that default is also expected there because of this mechanism, I show you that the behavior of some market like great default swap market that shows a massive misbehavior. And on US debt security, we'll see today with the data, and you'll be surprised, some of you, if you are not watching on regular basis, the premium has gone up. Now, if you're not aware or not very conversant with what the credit default swap is, for a layman, I will tell you, it's very simple to understand. It's like you pay insurance premium, right? And if somebody defaults, right, so somebody else will come and protect you. So why somebody is paying premium on a asset which is classified as risk-free? in the anticipation that there will be a default. Isn't that funny? So, and I'll show you that ratings are the one which is very critical. So typically you see the US debt, they are all rated, US government debts are rated AAA, right? And some of them has given a notch down also. And there was a massive impact, that massive ramification, the press coverage, and then of course, implications across the globe. If you ask the reverse question to me, is the Indian government debt security or RBI debts at 10-year or 20-year, whatever, will that be typically meeting the same definition of risk-free rate which you're talking for US debt? The answer is no, because that's as a, and if you go on the rating categorization, it is not at nowhere close to AAA. It's not even AA. It's BA, right? Kind of rating. So that cannot be called a true risk-free rate. But I'm today discussing with you that even a debt which is considered to be risk-free is not in true sense, in certain circumstances, a risk-free rate of interest. And therefore, there will be a massive misbehavior of pricing in outflow or inflow of fund across the globe and affecting your asset prices, affecting whether we are talking about commercial asset or residential asset or intangible assets or tangible assets across the globe, which has implications. Okay. So I have clarified here the special character of a government debt and explain you also that you should not get confused of the level of a government debt and don't think it is similar to a corporate debt. So in corporate debt, you have to meet the deadlines, you have to pay it, right? And most of the time, you will not be able to raise, right, the fund if your position is in distressed condition, then what part of the market faces a distressed condition. Whereas not is the case of a government, so long as the investor has a faith, and government can always roll over in and therefore can go ahead with this. The only issue about the coupon rate, which is going to be at which it would be rolled over. So we will. I will show you two important aspects as I promised. Debt ceiling impact. So see the two aspects together on a stock market and some, of course, events. And we'll discuss about inverted yield curve impact also, which is, of course, is a great predictor, especially for likely behavior in the stock market. And that's what I think 3 months, 4 months back when I predicted in Gurgaon using my data and that the markets are going to go down in the next 2-3 months, so nobody was believing that. Of course, there are certain fuel by geopolitics issues, and there are some other fundamentals which are the critical fact, but there are certain indicators through the debt market which one can easily infer and make a very qualitative decision. So what was in 2011 when was a debt ceiling issue similar to what we observed in 2023 happened. So we'll see the sequel, which is 2023. Is the behavior of the investor the same? Okay, may not be. And then see, when you make analysis, these are the key macros which affects, in analysis, whether it is going to lead to a recession. What the classical definition of recession is: inflation, energy, distribution, supply chain, and then we have a key disruptor, AI, in the market. So this is the data from of the CDS which I was talking about. I have done a small part of that, calculated the implied probability of default, which you can calculate based on credit default swap data. So just watch it here. What was the credit default swap data in somewhere in May 2023? We've seen the dates earlier, which I saw. It was known that the debt ceiling was going to be breached somewhere. That's what people call it as X date. So X date is the date which would predict the date when the debt ceiling would be crossed. And look at the changes in the credit default swap premium, which is given here 69.76 basis point. with a probability of default where R is a recovery rate of a 40% recovery assumption on May 19, 2023, using this formula given below. That's how it's calculation made by me. 1.46% there is a probability of default. So by definition, these kind of instruments should not have any kind of a default probability. There should be a zero default probability. That's how the definition is. A risk-free instrument, a risk-free asset should be an asset where there's no question of any default. But the market is paying. Why? Because there was a fear in the minds of the investors across the globe that what if the Congress or the complexity of the US political system, if the debt ceiling is not raised, then what will happen? And therefore, there was a market, and this was not a small market. Let me tell you, this market was around $12+ billion. It's a huge for a serious market, and that when you have underlying called risk-free assets, one of the most accepted risk-free assets of this planet, has got this level of a probability of default. Of course, on June 2, when the matters got resolved, or there was a political consensus that the debt ceiling will be increased. So you have government debt. Government debt is one component, which is a cumulative impact of your debt deficit, and then you have a debt limit. The moment it was more visible, you can see by June 2, 2023, the probability of default started coming. I mean, less than 0.50 or 50 base, something equivalent to negligible. So interesting for all of us to know that what we consider as a pure risk-free instruments, so US government securities, they are not. In fact, you can see this data is validating our proposition that even those instruments in certain circumstances when there will be a default, if this happens and you price an instrument or you price the other assets, because for pricing all other assets you require risk-free rate, and if this risk-free rate itself is not meeting definition of risk-free rate, most of the time your cost of capital calculation will go wrong, and people have made error without knowing that these factors are not captured. Yields would not be properly reflected in that sense. Now we'll observe a very interesting behavioral finance angle, or you call it as a more larger impact. You call this as a behavioral economics issue. Behavioral finance is one of the component of that. I would recommend all of you to, if you have already not into this field, focus on emerging area of finance, is the behavioral finance, because it will help you to interpret, infer people behavior in given set of circumstances. In past, and in fact, some of those technical analysis and other aspects which you do, you believe that past behavior will be repeated. But that will be a foolish situation. That's how I brought two events of a similar magnitude almost, and a kind of a similar nature, and in the same economy, right? Only differed by time, and you can see the behavior what happened there. So if I go back and show you the pictorial form in next presentation, the debt ceiling event, I call this debt ceiling events are the events in US history, of financial history, where there is a likely chance that because of the recurring debt deficit, the amount of debt will increase, the amount frozen by legislation, and that is the debt ceiling, right? So then the option is to increase the debt ceiling and then continue, and then go and do your routine exercise in the monetary policy part. So what happened then in 2011? Same thing what has happened in 2023. So that similarity is observed, that despite all kind of a disagreement between two political party system, they finally agreed, and they agreed in the last minute. I'll show you what we call now as a bless attitude. That's a very important part we'll see of a behavioral finance angle. A bless attitude is where I see that, oh, I've seen this thing in past and I know the implications, so I'm not bothered much. You get shocked when you have not seen anything, something similar of that scale. So something which was taken very seriously by the market in 2011. I'm not saying that before that there was no debt ceiling breach. There were a number of instances, but that was very special and very similar in terms of magnitude and etc. So there you could have seen is sparked the market volatility across the globe, all stock prices, bond prices, everything as bond yields, everything fall, and then credit default swap widened. Widening credit default swap, which you saw just before in the earlier slide, is an indicator that the market is asking more insurance premium, right, for protecting those kind of situation. And of course, in this kind of a melee, the gold surge and the dollar strengthened. Okay, and that was the first time you can remember in the history of US the clear downgrade, because ultimately what I will show you that in 2023 they were only saying, still keeping AAA, saying negative outlook and positive outlook. That's what, just changing words here and there, not much impact. But the first time a notch down, so AA plus is not AAA, right? So which means a downgrade happened, and there was a huge issue across the globe. And of course, S&P did that, and the person who did was the Indian there. Now, same thing has happened in 2023, May 2023. One would expect the same thing to be repeated. Only one thing got repeated was the consensus that yes, there is no way, because presidential election is there, and therefore you need to raise the debt ceiling. They could not have stop this. You can't go ahead with not raising debt ceiling, allowing the debt instrument to default. That would have been created a huge impact, a lost faith of investor across the globe, especially in this kind of interesting exercise. So what I'm saying here is that uh, uh, markets were largely unruffled. And I explain you what the X date is, the date you expect that by this time, how you calculate, you see the cash available, and then you see the outflows which are due. So you know that this date you require a breach, or you require to increase the ceiling, right? The stock markets remain firm. Does much of the bond market except short-term behavior, and you can see the US dollar still was strengthening, right? It was a completely a different kind of a behavior from the investor, and those by something called blessed attitude, which is attitude shown or kind of behavior shown by investors when you find situations where you are saying, oh, okay, I've seen this movie, I know the director, I know the actors, and this kind of action is going to happen soon. I'm comfortable. So people are predicting on those lines, right? But they in some other market, like in CDS market, the situation was a little bit different, because sometimes in short-term behavior, that's why we call it short-term behavior. I mean, people still believe that there will be a likely disagreement and there will be no consensus, and therefore you have a rising a stock premium. But it was very clear, if you have looked in the past, the situation will be salvaged. So this is what a graph shows that. Can you see here? Roughly same level, around close to 70, your CDS premium here. And if you look at it here, the last, and in 2023 is close to that. The rest of that period is pretty low, and then that should be the behavior should be very, very less. Is a data over long period of time. And don't forget, we are talking about credit default swap premium over US debt securities. So means we are talking about somebody ready to pay premium to get protection from a default if you make a investment in US securities, right? The data shows that when in 2011, the similar magnitude kind of increase was needed, and therefore it surged, but surged for very short period of time and normalized when the issue is resolved. Same thing happened here, but this time it was not like a kind of a impact or bloodbath in the market across the globe, because market shows kind of a blessed attitude, right? So these are something you can see here, debt ceiling events and their downgrades and the impacts happening. And you can see here 3-month treasury bill and 1-month treasury bill, kind of a gap getting resulted. Why this happens? Because the shorter duration instrument will be more, you know, risky in that situation, because they need to be immediately paid or rolled over, and there could be a situation of rollover. So long-term instruments where due date would fall later on will have a lesser impact of these exercise. So even within the government debt, different types of instruments will behave differently. Okay. So this is again my backing here, what I said about, you can see here, this is your history of US debt ceiling. And you can see here US public debt subject to ceiling and a statutory debt ceiling, and then debt ceiling suspended. So every year now the debt ceiling is going in this exercise. Will this graph uh, move in this similar direction in future? Keep on moving like in a hockey stick? Answer would be yes, if you follow the same pattern. I mean, if you have the same kind of I'll show you that health span or different span, is going to go there, and your tax collections are limitations. So there are a lot of social expenses happens in US, which are pretty high, especially on health side and other part. Unless you curtail, maybe you'll be curtailing some defense expenses, but the political exigency may not allow you to do so. So that then you go and try to contain a non-defense expense. In fact, last week I was looking at the people suggesting kind of tax imposition, so that you can increase the tax revenues, or maybe a VAT 5% additional VAT, or maybe kind of increasing on payroll of 1% of a collection, because that's very huge. And there are multiple suggestions which have come up from various experts to ensure that your revenue or your income goes up, and as a result, your debt accumulation of debt because of rising debt deficit is reduced. Because if it keeps on rising like that, and interest rate can't be controlled for various reasons, then there'll be a big impact in terms of your asset pricing and movement also. Can you see here? This is a data around the same, 2023 debt ceiling close dates, right? So you can see here all rating agencies giving AAA. Typically with AAA, you don't have plus, minus, and something kind of that, but they still say negative watch or stable. So just within some variation, this is subtle kind of differences. But if you look at here in S&P 2013, right? The first time it was AA plus. So the moment it comes AA plus, not AAA, right? You will have big implications in terms of, that's the reason why, because despite what has happened there, at this point of time till May 25, because after the 1st of June or 2nd of June more precisely, yeah, it was very clear that there'll be no bridge. So there was no reason for reducing even a notch down. But then it was reduced. Why? Because it was the first time, and a lot of people behaved, and not only one, but two times a rating agency here, once in 2011 and 2013. These areas AA plus was given. The moment it moves down to that, the risk-free return, the true character, because your debt rating is not AAA, and therefore you are not meeting the definition of risk-free rate. Okay, here you can see which was the most likely expectation when your highest level of CDS premium on US government securities, but they did not reduce the rating from AAA to AA plus, just put a negative watch or stable position, right? Negative watch, you should not read negative into this. That only talks about that, yes, that's not the what we look usually in case of stable. So a little bit below that. Otherwise, everything fine. Can you see here? That's how I was looking on US cash balance position. So you can see it here. It was very clear that cash balance, large interest payment was somewhere due here, and this, look at the depleting status of the cash flow. So you reach to a debt ceiling position when you have a large payment of interest, large payment of principals, and your expenses are kind of very high, and your income is very low, and then because you have frozen your ceiling, so you require a further legislation. It's very difficult legislation to pass through in US. It requires 2 levels of approvals, and that's how it creates a problem. Now you want to see the market implications, so that's a very funny behavior again, especially if I have to read in S&P context. Then I'll come back to Indian part of that. We'll learn about that one by one. You see in this graph till May 2023, if you look S&P index, which is a market cap based index, so it looks like it's improving, significantly improving. Obviously, the market behavior was totally different. If you look at in that sense, compared to the debt position which was happening, okay, because you remember that these areas, the market was predicting something will go wrong here in May 23. There will be a breach and etc. But the S&P index is right. If you don't make a serious analysis, you'll get a false inference onto that, right? Where you have seen just before that, I mean, since January 23 to March 23, this was all colliding, right? So S&P index with equal weighted price changes. This is a very important, which tells you the true story, because S&P index, like in Nifty or like BSE 30 index or 500 index, etc., they have a behavioral, because of their high weighted securities movement, you'll see this increase, and sometimes we get a fall. So if you contrast that index with equal weighted price change year to date here, which is the yellow color S&P 500 equal weighted, this was falling. Now, what is the explanation for this? Okay, why the S&P 500 index is going up and then equal weighted price change is falling? Because if I have to interpret the debt equity market, look at that, we are facing a sequel of 2011. So 2011 was a very, very dark days. It's looking something very difficult situation. 2023, of course, we came out of the corona and so many global issues coming, but still the market is behaving absolutely in different fashion. But if you go more detail, these 2 graphs will tell you the rise of this was because of a lot of AI dominant stocks, and they were the one which were lifting the index up. The moment you get out of this market cap equity index, which is what market reports, and come back to the equal weighted price, you see there is a fall. So all other shares were getting affected. The people who were investing or are very ready to invest in AI dominated stock, and some probably could be $200 billion, $300 billion. Now of late you would have seen the implication after this. If you draw a graph further, that has also percolated down to India. So even if somebody who's not kind of nothing to do with AI or just naming it or doing little bit on AI, still people say that the AI companies will price it. So you have to go back in 2001 and see that at that point in time, the dot-com companies, anybody who were trying to increase the share price, they were keeping name dot-com companies, right? And at the end, so there were a lot of name changes just to fool people, right? And when it bust, after that, we also witnessed that more than 50, 60 companies changed their name, deleted the word .com. So that was the .com boom. Here it was all AI dominant. I'm not saying that AI companies are not value creators, they will not increase. I'm not saying, but not all of them, right? Just because you just write AI, I don't do anything serious or something which is competitive enough to maintain your competitive advantage for a long period of time. I don't think you'll survive because most of the AI will be producing crap because you have not filtered the data. You don't know the source from where coming and what kind of prediction it's doing. So this is a very important graph for you. If you only focus on this and see the debt market position, you'll see that it is completely misaligned. Whereas if you do a small adjustments which you've seen by two other graph, it is reflecting the same thing that the market is not doing well where the interest sensitive industries, okay, and which requires a hell amount of the debt funding. In fact, AI stocks mostly are funded by equity instruments, and there are a lot of expectations. They were not listening. They were looking at the what is called as long term. They were not listening at the debt position today. They were thinking that these stocks are going to be a value creators in the long run. So market was moving in a looked like to move in a different direction, but in fact it was not. I hope you understand what I'm trying to, explain here in terms of this data. Okay, so why we said that it is very important to understand behavior part of the market by behavioral finance, and also to have a serious look at debt market, and especially the one which is categorized or considered as the risk-free instruments, the safest instruments on the planet, US Treasury bonds or government securities, right? And this then becomes a fundamental for all valuation across the world. And if it is not, then it has impact. And it maybe for short term, maybe for the long term. And you can see those behavioral aspects getting reflected into this. So what we are looking at that all assets are priced or repriced, right? And has the impact from a the foundational part of the risk-free. And risk-free you can only understand if you understand the US economy and everything across the globe. Under the current structure, I don't know in future things are going to change. People are moving away, and there could be a politics happening, and there's a lot of groups coming up with a different kind of currency structure and their settlement. So probably the situation will be totally different. But for the time being, it is there, which is what we are looking at for pricing purposes, right? And then we can see that why there is a premium on risk-free asset, and when there is a strong visibility of breach, and then of course breach flows from where, which we are aware. In a market where it is linked with in a percentage terms, like in India, it's not frozen. Most of the countries across the globe is not frozen. You will see that the behavior will be totally different because the market believes that some percentage here and there is not going to affect that important part. The second thing which is linked with this, because if this risk-free rate yields are going to go change, then you have a impact on monetary policy. And especially across the globe, if you see, that is a very classical situation where what I mentioned as a QTP, that is a quantitative tightening policy is happening across the globe. And they were, the implications were that the objective of that was because of after the corona, that inflation, I mean, same point in time across the globe, and very few instances in the history where you can observe this kind of inflation happening there. So what the monetary authority or the regulator will do, that they'll try to tame the inflation, and they follow what is called QTP, right? And they believe that because of that, if I follow this monetary tightening policy, ultimately across the globe, I'll be able to contain inflation, because that's probably is the one of the most important objective of any monetary authority across the globe. Sometimes this, I think, would have, if I would have got more time, I would discuss with you that a lot of time this decision making in the monetary policy, uh, you know, in order to tame inflation, makes errors, and that results in basically stalling the growth, and that also you're seeing across the globe. So you're tightening monetary policy, inflation is rising, but still the growth is not coming. Except, of course, India story is different. We'll discuss separately for that part. I'll show you some implications there, and the visibility of the data. Especially important for us to know that inflation is a lagging indicator, right? So which means that you would have done something before, and that is getting reflected. So if I'm not following a proper routine and not having proper food and etc., so there'll be some implication on my body. So something will come up, and somebody will say that you're not doing well, okay, but the impact must have taken in past. So based on that, in order to correct, you tighten the monetary policy, and that creates a problem, because the objective of monetary policy basically is a leading indicator. So it's trying to give you a direction. Most of the time you'll find the market will not listen, and there will be no implication. In fact, there will be a counter implications, and this is what is the important aspects of the linkages of your risk-free monetary policy, and then asset price, and then across the globe you can see the implications. So there is a very clear visibility of a commercial assets prices falling significantly across the globe. Again, a very important information, whereas the residential asset is not fallen to that extent. Okay, and these are all asset risk-free rate sensitive asset, and that will have an implication. So when we look at more about that, now just expand this knowledge in future. So what is the likely situation if you were there in US? And then of course there are a lot of people who are commenting, and of course those are very advanced level of thought process going on to change the a kind of a cyclical basis implications. So when you go for see the inflation rising, tighten the monetary policy, and try to wait even the growth is compromised, and then reverse the cycle. Again, for us too important to understand whether this 32 trillion debt is going to pile future in future, and kind of a market opportunity which you can see in India. Just see United States spend on healthcare. In my comparison, of course, I've done a lot of work in health sectors across the globe to understand this. The quality of service is also not very good. In fact, some of them are inferior to even what we provide in India. And look at the cost in the United States per person, average health cost per person. And this all, has a burden on exchequer. If you, and then combined, so we have a program on 4th of November and one of the theme is understanding the demographic profile. It's very important. So you need to understand US demographic profile, the population age, the kind of composition of the population. It will be very easier to predict, and the cost of services. Combine these together, you'll know that this bill on health spend is not going to come down. It's going to increase. Also, there is an opportunity for people to provide similar kind of services if or outsource some situations, because look at the gap. So if quality services or medical tourism, etc., so they have to rechurn strategies, a routine process of handling this debt in US is not going to work. And the other way to increase income has another implications, and that implication would be unbearable to the population. It's very difficult for various political region. Now economics is taken out of the picture, and the political issue comes out to reduce this or somehow reduce this expenses, because the more and more people will age, and the expenses is going to go increase. Now we'll discuss about inverted yield curve later on. Just a flow of data for you, which I've sourced from Michael Gate. So over a period, you can see here 20-year Treasury bond, colored, and an S&P 500, flow over a period. You can see the market behavior, in terms of your yields, and that's all correlated, right, with your interest rates and debt position, and an S&P, which is equity market implications, right? I'll show you this in a much better graph here. If I look at the physical deficit and gross deficits of G20 countries, you can see here till 2023, which means up to March. You can see that the average kind of percentage of GDP physical balances, which are the countries which are there. You can see here India somewhere 5 to 6%, and then most of them you can see in a very difficult position, except few countries which have got a different proposition. Versus, look at that now, the gross debt. This is very important aspect. That's what we were talking about. That who has got the maximum. So it's not in terms of your gross debt. If I have to plot a graph, percentage of GDP, US is not the one which has got the maximum, but the size of the US economy is pretty large. And as a result, if the interest rate is going up, it's not what is the GDP. Debt as a percentage of GDP will give you a very clear picture. What is going to give you a clear picture is that what is the interest rate prevailing in that economy. For instance, even if Japan, you can see in the Japanese economy, the GDP debt versus GDP or debt as a percentage of GDP is higher, but the interest rate they have been negative or zero is they have been maintained over a long period of time. So you can't compare US versus Japan, because they'll be able to maintain. In fact, they're pumping this to get kind of a target growth, right? To improve growth. The demographic position different here. Demographic position different. Now you can compare with India versus US. You can in terms of percentages, because this is GDP. If you see this spend of a government on healthcare is more on personal and less, very less as compared to US, and the government spending is nowhere close to that, right? So now we'll be focusing more on India, and then I'll take you data on a concept of inverted yield curve. In fact, yield curves, which basically we construct in using data of debt market, and construction is pretty simple, where you just plot of a similar kind of a instrument, only differing in maturity. So same risk instrument, differing in maturity. So say take example of government of Indian security, some maybe 1 year, 2 year, 3 year, 4 year, 5 year, 30 year. So they are only differing in maturity. And if you draw a yield curve, we draw a graph, right? When you plot maturity on x-axis and plot on y-axis, you get yield curve. The behavior of yield curve are a very strong predictor of equity market, which I'll show you later on. But let's first understand some other segment, because in India, as I said, as compared to US, where it is more capital-driven market, there are a lot of investors in that space who pump in money, in kind of a risky investments. To say more precisely, they invest in assets which are innovations, which are the new things which are coming, and they expect and they invest. In India, we don't have reached that level. I'm not saying it's not there; it's there, but the ecosystem is not there. I've seen people struggling here, even though they have a very good business model, very good technology. Uh, but there is nobody to fund them, and they probably lose uh, prime time. I call this because in each innovation, it's not as if in today's world you are the only one. There could be somebody else, in other part of the world. So if you don't get funding at right point in time, so there is a value destruction going on. Somebody else will come and probably rather than acquiring the market across the globe, you will get acquired, right? So that's a value destruction because you don't have the ecosystem, you don't have a plus of fund uh, who who can make investments in those innovations and technology which are game changer or in more market terms the disruptors in the market. So some data set, especially the one which I picked up here, few, could be very handy to also understand the Indian segments. And one of that is because I said we are more on a bank-driven economy. So if the bank, credit portfolio goes up, I'll also show you that which are the component of the credit portfolio. Having sat on the bank board, I'm pretty aware what kind of discussion is happening in the board, where should we go. And unfortunately, though in India, mostly in public sector bank scenario, you have few consultant, pretty common consultant, and they will advise you the same thing to all the banks. So each one will go and create a kind of a focus or a strategy. The duration of MD or CMD is very less, maybe 2 3 years. So all short-term behavior will be reflected. There is hardly long-term effects happens for 6 months or 9 months or maybe 12 months goes in cleaning up exercise of the earlier issues. And then by the time you try to change, the one who comes takes all decision, it all becomes person driven rather than process driven. And as a result, again, it goes in a different pedestal. So understanding the growth of data in Indian banking system is very important for all of us to appreciate or infer out of those details and how sustainable those numbers will be. Sometimes the reaction of the market also will be exactly opposite to what you think of because there'll be a players and those players will be just pumping up the prices, taking it far away from its true value position, and those are the stocks where your free float shares are less, or there are some design and objective to defeat that. But still, the data helps us to capture this. And can you see here? I'm just referring the first one. It's pretty interesting that which way the market is going. We have two set of data. One is the credit, another the deposit. So one helps the fair balance of liability side of the bank, another helps in the you know the asset side of the bank. So you can see where I'm saying credit and the deposit. So deposit, this is how the bank raises money, and this is how the credit outflow is happening. So there's a lot of impact happening in the banking sector. That means they're lending and lending seriously, but deposits have fallen. So there is very no match of deposit. Earlier, you can see here in earlier period, and mostly is the COVID era, you can see it's reverse was happening. There's a lot of deposit, credit fallen. Credit is picked up. So what happened in that? If this situation happens, then you have situations where you need to pay more premium for deposit, right? So the bankers will run, and then a lot of consultant will come in picture, and you take deposit for a sometimes for a longer period to match your credit expectations. So what do you do there? You create a lot of problems which probably will be reflected in the next 2 3 years, right? How? I'll tell you, you borrow money at a very unsustainable cost, right? just to match your growth. You want an asset growth. These things you will not find on the basis of ratio analysis, these number and that number. So you can understand that they will surface, because what you are doing is you are trying to and whether I'm trying to raise unsustainable level of kind of borrowing at a higher cost, you can find out by the interest paid and interest received gas, right? That is, here I'm paying high cost and raising money, right, in the form of deposits from public, right? And at the same time, in order to increase, growth on a credit side, I would be underwriting a substandard, asset, which means I'm lending to a company or a customer which might not be, kind of acceptable, or the credit rating will not help, the business model will not help, operational level will not help, but you are under tighter process, you are under a severe pressures from your top to increase your growth. So you are borrowing heavily and increasing. So the impact of this in terms of your future performance, in terms of NPA, in terms of your, shrinking interest margin will be reflected maybe 18 months or 24 months later. You'll not know, but this guy who's come for 3 years will show that, oh my God, I have increased. Look at that, my credit growth. I've turned around the company, right? But you have literally created a lot of troubles, right? So each bank has to manage, and then based on that, you will know that whether it will be sustainable for the overall economy or not, right? So this is a total holistic situation. I'm not talking for this is one bank. Similarly, for the liquidity situation in the banking industry. So in COVID time, it was 8 or 9 lakh crores. Roughly is the liquid item, and then to support this growth, all liquidity gone, and then we require liquidity issues in the market, and that need to be supplied from somewhere, and you get a problem here. Also reconfirmed by credit deposit ratio. This is a regular discussion in the board of the bank, and it also gives us a pulse of the market, where still hold. Any interpretation at macro level of these data without looking at the micro part of that, that means the component where this credit is going, rather than looking only at credit deposit ratio. It's only going to tell you how much you're lending versus what is my deposit ratio. So looks pretty comfortable, because 70, 75. This of course was low. So we all know why it was low in this period, because you've seen earlier presentation where the credit was less, and then of course deposit of people started looking for deposit when there is a outpace, there is a competition. So what the consultant were advising, most of the banks, they were advising to focus on RAM sector. So what is this RAM? So retail, agriculture, and MSME. So looks very, I'll show you some data about MSME, looks very, unbuilding in Indian, and some has to think on policy part, because we talk too general rather than going on more realistic picture. And most of the MSME, I can tell you in India, they do face a problem of fund, of course. I'm not denying that, but most of them are not going to be that matter, and the issues they face cannot be resolved just by giving them loans, or even in some cases by providing equity, because most of them are facing technological obsolescence. Operational inefficiencies have factored, because they were functioning in a different era. Things were taking time. Here things are changing pretty fast, and unless those things are addressed at that level, the problems of MSP will not improve. As well with the data, how many MSMEs are closed down? So we have that data, we can see that, and they've closed down their operations with the bank. Is pretty concerning, in a sense that you would expect MSME to be with the bank, not with the NBFC. I'm sorry, I'm not against the NBFC. They do a better job, and of course, they have a role to play for certain kind of borrower. But if a lot of people who were bankable earlier, moving from banks to NBFC, where the cost of borrowing is substantially high, right? In some cases, it could be 600 to 800 basis point as compared to bank in today's situation. So they will be operationally wiped out. They will try to survive and gets their profitability gets affected, their equity gets affected, and then of course long-term position, and then over a period they'll be driven out, right? Because they're not addressing so operational part. They're also now getting locked in their financing position and unsustainable position. So what it says, if I look at here, I'm just looking at this data. This all data come from the debt market, right? So obviously the bank is driving that, sometimes because of the government push, sometimes because of their own competition. What the bank focus was in the RAM sector was, one was the MSME, another was agriculture and the retail. So like you give more loan to housing, you give more on the bike loan, you give more car loans, etc., right? So what they were trying to do is that if everybody tries to do a business there, or on a personal side, the personal side also includes in RBI data, the NBFC. I'll show you that growth number. So what you're trying to do, you think that I'm reducing risk because rather than giving one chunk of a loan, right? Credit deposit ratio will not tell you that where the money is going. So you have to go for a macro level to understand that what kind of risk you are doing. So if you're basically pumping in money in these sectors and believing that my risk-weighted asset, which is very important concept in banking industry, because there are certain borrowers or there are certain population of borrowers where the weight of risk will be, very low, and some cases will be pretty high. To give an example so that you can understand, if I invest 100 rupees in government securities, the risk for this is zero. There is no risk, right? But I've explained that it's not exactly risk-free. But for calculation part and for practice part, we're taking zero. But in some industry, if you lend for 100, your risk-weighted asset could be 150. So what bank does it by moving into these kind of sectors, what is called a retail, agriculture, MSME, they try to reduce their risk-weighted asset. So if you reduce the risk-weighted asset for a similar level of kind of lending, what will happen is that it is linked with your capital adequacy ratio. And therefore it will release you fund for lend more. Okay. So what is now happening if everybody does this on a fundamental principles, on thinking that if I invest in all these sectors, so therefore my risk will go down. But what is happening is that you are reducing risk at individual level. That means for one bike, one home, you are reducing, but you are increasing risk at portfolio level. That was the reason why a bank like Citibank had to wind up their retail portfolio. Pumping in money there itself does not mean that your risk is not increasing, rather reducing. In fact, you see the true picture is the portfolio level risk could be rising. How? Some banks will go and then buy some retail portfolio from NBFC. So, and then later on go, oh my God, I bought what is very bad, even housing loan. So if your housing loan gives you a NPA of 3-4% or 5%, I mean, this is ridiculous. You can't sustain that, right? This is considered to be something less than 1%. If you buy an asset in pursuit of increasing your asset and then raise a high cost of deposit in this scenario, right? So you're expanding your balance sheet, you're going to pay in future for that. And get my point? And that gets reflected in your whole aspects in coming day. What I'm trying to say, credit deposit ratio at a macro level does helps me, 75% or 80% kind of thing is okay. The money is not is earning a lower level of return, because banking is all about taking risk. You have to pump in money, decide about the risk, and then you can't go and find all AAA level of a credit rated level of a client. So you have to take a call. I want to go in AAA, I want to go AA, I want to go AA plus, etc. I mean, there are so many, each credit rating category will have plus, stable and negative, rating. Up to BB negative, and below that you go, each level, this result will be totally different. What I'm trying to say, in the pursuit of expanding your balance sheet, that is called the asset size, you raise a high cost of borrowing, tomorrow your asset will start non-performing, the high cost of borrowing will remain there, and that's how your equity will be wiped out, right? And it will have a huge strain in the banking performance. But the market reaction will be totally different because it is a short-term behavior. People will see in quarter to quarter what is the change in return on equity, what is the change in return on asset, okay? Has that interest margin expanded, etc. And the market start building in. I'm not saying for all, but majority in this situation. But if you understand more deeper of this, that this macro level information is only indicating us to know that yes, credit is going, but now we'll see where the credit is going. And based on that, of course, these two lending rates are also very interesting part. One is weighted average lending rate, and another is your weighted average lending rate of the outstanding loans and weighted average lending rate of a fresh loan. You can see here in a fresh loan and versus your outstanding loan, you can see here it has fallen, right? And above the sector banks. If your weighted average lending rate is falling and the cost of borrowing is rising, right? So deposits cost is rising. That will be more trouble because you're now facing competition in the market. Everybody focusing there in one segment of that in pursuit of reducing your uh, individual level asset risk. But by doing so, indirectly you are increasing your portfolio risk, right? So this also is a situation. So going to tell us about how the market is going to expand in the future. This is very important set of data that will tell us that how stable would be the bank, how strong performance is likely to bank, and then you can predict the economy and then of course the sector which are going to get affected. So these are some interest rates. You can see how it is compiled and it can make out of this how close they are with the risk-free rate and how much difference. So these interest rates, something less than 10% is what probably helps you to think about capex if it moves. I mean, just giving a general understanding. Bank to bank, it varies because each bank has their own position and they have their own strategies and moving in that. So, how much expansion is going to happen in bank? You can think on a macro level and the growth in the economy in Indian sectors, right? Of course, some volatile money comes in capital market, and then of course some private equity venture capital market, but they are not that much of a driver which will affect the whole segment, right? Now, this also is very important. So we've seen that weighted average lending rate of outstanding loan, weighted average lending rate of fresh loan, and why on fresh loan the interest rates are falling because of the competition and where you are finding a situation where deposit rates are rising. That is something mismatch happening. You can make out of this and see the bank how they're responding to this. Here you can see weighted average domestic term deposit rate of outstanding deposit and look at the steep curve of a fresh deposit. Can you see that here? There is a point where in this time, of course, here, because there was no activity happening there, just forget for the time the repo rate, focus on public sector and of course, commercial banks and private sector banks. Here, they're all aligned, moving here, but now here you can see who is trying to do that. The PSBs, this is what the PSB, they were more aggressive, right? And they're trying to take more deposit at a higher rate, okay, as compared to the private guys, try to maintain their asset size because they need money to do that, and or maybe forced. So whether the managerial efficiencies, I'm not against the growth. In fact, I love that, because that's how it happens. The economy should be expanded and reach to the full potential, but at what cost? Are you only focusing on the growth part of that, or you're also focusing on the sustainability of the growth part of that? unless you read this data set, which are all flowing from the debt market. Debt market is only not government yield and some information which is compiled. It's all about understanding bank. I won't be doing a similar kind of exercise in US. Of course, these data are very important in any economy of the world. No doubt about that. But some economy it is more sensitive is compared to an economy where you'll find a situation what we are talking about where the growth is fully dependent on the funding of a bank, right? And that's what we are talking about. Now just see this is a bank. You see the headlines in the newspaper. Okay, bank credit grew by 15% in FY23, right? I'll be more interested rather than looking at this number. Okay, that's fine. This growth is fine. Now I'll have to see that is that growth sustainable. So we have seen that how the things are spanning there in terms of my deposit rate. What kind of aggressive exercise being done? Just because other banks are offering deposit rates, you'll be forced to offer deposit rate, which the other bank can sustain because of their size, because of their position, because they have a cushion on their capital adequacy ratio. You may not be, but you are following because you have to there in the market, you make error, and then they get killed, over a period. Can you just see here where this growth is coming up? So FY23, you can see here, this is the total bank growth, credit growth of 15%. Looks pretty handy. 15-20% growth in banking sector is pretty handy, believe me. Anything less than that, people say that you're not working, right? So 10% is acceptable. Below 10% is something. Of course, it's not an individual bank level, so you can go and make understanding that. Also, sometimes base level will be low. For instance, this 15% has come on a backing of a very difficult phase of economy, especially I would say COVID-infected economy, right? So don't read too much in this 15%. What you see that on this services part, there is what the NBFCs are there. Look at that, the industry is nowhere, just 7% expanding here. Services and personal. So this is what I'm troubling. Read carefully. Okay. So here the maximum growth is happening, and roughly more than 50 roughly 60%, if you see, is all composition of growth is here in these two sectors which consist of NBFC, and that's what your personal sector is there. So now all these guys are dependent on industry, isn't it? And these guys are dependent on the banks itself, right? NBFC rising, okay. When you say that the banks are making things easier for people and therefore they give an affordable rate of interest, a person who's going to NBFC more likely is one who cannot get credit from banks, right? Having said that, and again repeating, I'm not against the NBFC, but the kind of growth which is happening on a credit on an average growth looks very good. But if you look at this growth because of the NBFC growth and because of personal sector growth, personal sector is fully dependent on industry. This is what is going to create employment. Okay, this is what is going to create a more opportunity. I'm not saying this will not create a employment. These guys, if the interest rate goes up, they are going to go default even on personal level. And so would be the case of this, which already have seen a situation at some point in time. Some of the NBFCs were priced to book of 5, 6, 7, and amazing, a balloon, and because they're able to maintain kind of interest rate margin of 6-7%. So who are funding them? The banks are funding. Who's taking risk? The banks are taking risk because if these guys will fail, the banks will fail. But are they pricing the way a risky instrument should be priced? No, they're pricing in a normal credit, the credit rating of NBFC, whereas the NBFC, when having seen the growth opportunity, they start underwriting compromised or lesser quality customers, and then they compound the risk here. The risk premium is not passed on effectively to the bank. they earn the same, but they feel that, okay, that doesn't get reflected in my financial statement. They feel pretty happy. If this guy fails, the banks will get affected. And that's how the cycle which you need to read in. So I'll show you one more important data, right? This is also very important for us to know non-food credit growth year on year. Sector-wise, you can see that which are the sectors which is going. And you can see here the services topping. Look at that. The kind of graph is jumping, right? So where things are moving here, right? What happens in our industry, right? Okay. This, of course, the data is up to the March, but I'm very uncomfortable. What is sustaining though is the growth in the agriculture part of that economy, right? Or allied activity. But then, of course, state-wise, if you capture in India, you will find this can turn bad any point in time. Maybe because of the near of election or announcement by political parties or leaders to wave off, etc., will create havoc. So it's very difficult to risky in my proposition this kind of a game. But on here on industry side, it should go up. It will expand in economy, and that is what the bankers are flowing here on retail segments. That I'm not saying we should not give a retail, but should be back. The growth should be similar. You can see here share of major sectors in all scheduled commercial banks. Incremental non-food credit. This also is very important. Incremental non-food credit. If you see here again on services part, okay, it is expanding, right? On industry part is in fact is shrinking. Is not a good side, right? Uh, and agriculture somehow is able to maintain that, and the personal loan is expanding. So these two are expanding: personal loan and services sector expanding. Industry segment are not expanding. So you can think about how sustainable this growth is. If I read them in silos, component wise component, it looks pretty, very very smooth. But if I try to correlate them and see that, for instance, if I am a retail borrower, I'm dependent on somewhere I'm either providing services or doing kind of a job in company or industry. If those people are not expanding, so my ability or then the interest rate goes up. For X reason, you are going to face music and it will have an impact. Okay, so now I'm going to share you this data. I mean, of course, this data has come from RBI annual report 22-23. It's pretty comprehensive document. Can you see we have around 63 million MSME, right? Just focus on this numbers. Roughly 6 crore contributes around 29% of the GDP. Each bank is obviously, because of the largest sectors of contribution and employment. Of course, you can see here the employment 130 million, so roughly 11 crores. So almost equal to 40% of the total employment. If that be the case, just focus on something which is pretty interesting, right? And this is about what I don't only focus, which most of the time people do, would like to focus on amount outstanding, right? And they try to see that how much is growth is happening, and that growth would be happening. Most of the press would be covering the growth in terms of amount, right? So from last year to this year, how much it has gone up. So it looks pretty good number there, right? Can you see it here? How many accounts have gone down? Okay, something of which was here 4.4 roughly here, it's gone to 3.2 in medium enterprise segments, right? And number of accounts have fallen from 420 to the MSME segment in totality to 203. Where they have gone? That's my point is, don't look at this number. So if you look at this number from 1700 to 2150 or something, it looks pretty nice. If you look at this number in the micro part from this to this, it looks pretty nice. But which of these accounts have they been closed? They've left the banking sectors, they've gone somewhere else, trying to raise fund in a private basis, and then they closed the account. I'm more concerned about that. Okay. So as I said earlier, all these numbers, even though they are part of the credit system or the debt market segment, a larger expanded version of the debt market segment, I can say, these are telling us that they require some kind of a intensive review and scrutiny. The where it is happening, and we'll find the result for this, the one which I discussed earlier, the operational inefficiency and the technological obsolescence, unable to compete in today's market. And obviously, I'm not going more on tax angle that what could be the reason for those. Those are some cases, yes, but on a larger perspective, despite the position of a bank that they are growing in MSME segment sector, the falling number of accounts are critical. Okay, in an economy where you want a sustainable growth, these accounts should, if it is not increasing, they should be maintained. In fact, it should increase because more and more people should come, and I can't believe that we have so much of a merger that or consolidation which reduces this accounts and just, I mean, 2 3 accounts reduces to one. One vision could be there, which to some extent can also explain. One has to understand that earlier there was a current account which you can at will you could have opened. Now because of the RBI restrictions, this number of current accounts. When you want to open a current account, you take require an NOC or have a. You can't go and open multiple current accounts without any reason. So that could be the one aspects, but it's not all aspects. Okay, there are situations where some accounts are closed or these guys have moved from the banking sector somewhere else. So growth in this sector is not as one would expect. In fact, the growth is more. So you can see where there is a more employment, where there are a large number of people are involved. The growth is happening around 6-7%. That was the status till March data. Of course, there's some changes after that, which I'm not discussing right now, but the next 6 months. Because the objective of this session was not to go and see what exactly is the result is. The objective was to show you a kind of information that what you need to make analysis of. And this is one important aspect is if you have to think about India's growing economic part. Now, also the data from the external commercial borrowing, right? So and then in use of that, if you see the end use where it has gone, okay. So you will find that the which sectors it is moving in, and you can see here in 22-23 is in a negative trend, right? But this also is talking about that where we are expanding, what kind of capex is happening is not, all kind of features will come up, and this is obviously end use is a very important for us to know which are the industry where it is going. You can find out and then link it, and then track those industries. It's a all reverse way of looking. Similarly, for your FPI, foreign portfolio investment exposures in equity, can you see that how it has changed, right? To 2021-22 versus 22-23, right? So you can see where people are getting out and where they're trying to move in, right? So these are the sectors which are up. Now these are the sectors people just wanted to close it, and they are moving here, right? They are moving here, and these are the sectors, right? So this is telling us that where interest of FPI is there. I'm not saying this is the only indicator and focus only on one set of data. It will always be making error. It's not where FPI makes investments is always the right investments, right? So this is one set of data which helps you to catch them quickly. This is your net investment in equity by institutional investors. You can see is happening versus FPI and DIs, right? Look at that. FPI and DIs kind of ownership. Okay, so DI ownership is going up and FPI ownership is going down. That was till March 2023. Then again, the debt market, US gone relax, the situation will reverse. So all those kind of predictions, then you have to think about that which sectors is going to go, where their interest is going there. That is what is a very important exercise, right? And you can see here, a portfolio investors' behavior is different versus mutual fund behavior is different because there are a lot of money coming from investment sides because a lot of money people saved during those COVID period. Now, these are all your IPO mobilization data, IPO and FPO. You can make out which of the sectors people are pumping in, right? And this is a mutual fund, of course, monthly contribution data. So this also tells you that how sustainable would be the future in terms of you're lacking. Now, I'm going to focus because just we left out, 3-4 minutes more. Debt cycle understanding is also very important, right? So what stage of debt cycle we are there, right? And for that, the people keep on changing the goalpost depending upon the market situations happen. Please appreciate this point. Sometimes, you've seen people saying the real estate was good and make investment there. Then they found less, returns were getting less, money was getting stuck. So they say the keep cash, be liquid, and therefore move into this. What we are trying to see in terms of a debt cycle is that lending is the one which basically creates different set of debt cycle. Okay, so to understand India's debt cycle, you understand the way the bank behave and the way they follow the strategy for credit. So reading credit policy of a bank and then seeing the ground reality in terms of which sectors that they are focusing in terms of number. Even if you don't have access to a board, you don't have to be, and you'll be able to know that. Finally, what happens is that you see that increase in lending, and then finally, if that lending is increasing at a very high cost of borrowing, those things are unsustainable and can create a big problem for a bank because not only they can't will get into the NPA, that means there will be no revenue on the asset side, their capital adequacy would be compromised. So early and healthy part of the typical debt cycle, you can read through that. You can find where right now is happening is the early and healthy part because things looks very fine. Debt to GDP ratio is all maintainable, as I said, looks very fine. This is what just for a few minutes you can see. If I have to compare in 2001 data, three things was there: recession of 2001, tightening of monetary policy, dot-com bubbles, which I've discussed about that, and then 9/11 terrorist attack. What happened? Federal Reserve lowered interest rate from 6.5% to 1%. Okay, so can you believe that? Here it was done. The action taken by Fed, basically, it was a very short, lip and swallow. What was the result? Subsequent period was a bubble and building most rapidly between 2004 and so this is all linking with the debt. This thing happened, and some of them was not known, and dot-com was something unheard of. Monetary policy is a routine thing happening in the market. Interest rate reduction was something which was done to pump in growth, but that growth was for a very short period of time. And why? Because it's followed by something which is, you can see here. If I have to read between 2004 and 2006, growth rate, I'm just giving a macroeconomic number. If you were there, just take back us in 2004, 2006, 3-4% growth rate, fantastic. Unemployment rate, these are the data people type, wonderful. Inflation rate was 2 and 3.5%, controllable region within this range. Everything was fine. Economy, was entering into a late cycle, right? Because this GDP was slightly above 2%. Financial and housing market is very good. Debt was everything fine. Market, share market was doing absolutely fine. And what happened next? Just see. Then suddenly things have started going in a different direction, right? So you started from seeing the interest rate rising and it rose. It's not as if it is rose in 2023 to 5%. It happened in 2006, right? And then started behavior of, you can see here, S&P returned 30%, 35% return between 2004, and that was a build-up period of the debt cycle. And then, of course, situations where, debt to GDP was around 12.6% in that period. 2004 to 2006 was a signal of bubble, and then we found kind of a, indication. These things keeps on happening in the market, and then we found something in 2008-9 and which followed. So I'll just show you that yield curve which we're talking just 1 or 2 minute time. Can you just see this yield curve which is plotted for 10 years Government of India right? So and 30 years in the Government of India yield curve. This is India yield curve, right? So typically, yield curve going in inverted decision. This is somewhere in 2020 situation is all about a reflection of a recession. I will show you that in US, you can see here 10 years minus 1 year yield. If you see whenever there is a negative territory, the market has fallen. Okay. And these are the some pointed parts. So this is Neil Harvey calculation. You can see that all 1, 2, 3, 4, 5, 6. These are all yield curves drawn, right? So 10-year, 3 months, or 10-year, 2 years term spread, right? From 1995 till 2022. You can look at that. These are all recessions. These are all recessions. So US in March itself or May, the debt ceiling is all moving into that direction. Germany has gone. And Indian situation, the first time we've seen the collapse of long-term versus short-term. But we still pulled it out, right? So inverted yield curve is a very important to summarize at the end, is a very important indicator if you want to understand the market, because it is interlinked and interlinked in a fashion through risk-free rate, right? There are other components, I'm not saying, but these are the major component and requires understanding of debt market to understand fully and comprehend the equity market, rather than looking from equity market to debt market. So look from debt market to the equity market. It will give you a sense and more predictability. In fact, inverted yield curve predictions are it's pretty close, 80-90%. They indicate recession. So in US, a recession is declared. In fact, they always declared later on once the recession is likely to be over. Okay, so it's already in recession, but National Bureau of Economic Research (NBR) they have super not declared. So some other economies are there, and you can see their debt market behavior, especially inverted curve, indicating that market, and therefore there is equal as. You can delay, but the impact will come. Somewhere it could be 3 months, somewhere it could be 6 months, something like that. So already we have crossed 3 minutes. So thank you very much. If you have any questions, can I take them on? Or
Thank you. Thank you, Rajiv sir, for such an informative session. I'll just look into the panel if anyone has asked some questions. No, sir, there are no questions.
so yes, late in night. So
yeah, sir.
I don't know. So people will be enjoying the match probably rather than looking at that market and equity market.
Probably,
So
probably,
tomorrow
sir.
it will be evaluated in the morning. Okay.
Yeah. So I would thank you, both of our speakers, Rajiv sir and Prakash sir, for such an engaging and thought-provoking session. And I would also like to thank Committee on FMIP, our chairman sir and our vice chairman sir. So thank you everyone for attending the session. It was indeed a very insightful session.
Thank you, Shreyas, and thank you, Prakash, and thank you all audiences who joined today, booked to the program, and I think probably 3 hours. They were attached with the program, and hopefully they'll view it later on. Thank you very much. Good night.
Yeah. Good night. Good night.
Bye-bye.